declare open this hearing of the Senate Select Committee on the operation of the capital gains tax discount. I want to begin by acknowledging the traditional custodians of the land that we're on and pay respects to elders past and present, and extend that respect to Aboriginal and Torres Strait Islander peoples here today. The committee will be conducting today's hearing in person and via video and teleconference. These are public proceedings being streamed live via the Parliament's website, and a Hansard transcript is being made. I remind senators of their obligations under the Behaviour Code for Australian parliamentarians to treat witnesses with dignity, courtesy, fairness and respect. I remind all witnesses that in giving evidence to the committee they are protected by parliamentary privilege. It is unlawful for anyone to threaten or disadvantage a witness on account of evidence given to a committee, and such action may be treated by the Senate as a contempt. It is also a contempt to give false or misleading evidence. Witnesses have a right to request to be heard in camera. If a witness objects to answering a question, they should state the ground upon which the objection is made, and the committee will determine whether it will insist on an answer having regard to the ground which is claimed. If the committee determines to insist on an answer, a witness may request that the answer be given in camera. I remind any committee members and witnesses who are appearing via video or teleconference to please mute your microphones when you are not speaking. I now welcome representatives from the E61 Institute. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full names and the capacities in which you appear today?
Michael Brennan, the CEO of the E61 Institute.
Thanks, Mr. Brennan.
Matt Nolan, Senior Research Manager from E61.
Thanks, Mr. Nolan. I now invite you to make a short opening statement, at the conclusion of which we'll have some questions for you.
Thank you very much, Chair. The E61 Institute, for those less familiar with our work, is a non-partisan economic research institute with a focus on data-driven, evidence-based insights on relevant policy issues. We made a submission to this inquiry outlining some attributes and potential weaknesses of the current CGT discount, and today we're releasing some further analysis based on a unique microdata approach, taking information about anonymised information about individuals' actual behaviour and tax paid over the last decade to effectively simulate alternative policy approaches to taxing capital gains. So we analyse what outcomes different approaches would produce had they been in place over the last decade or so, using the actual data on capital gains that has occurred over that period. Our contention is that the use of this microdata highlights some important aspects of the current CGT discount that get missed when we only look at the averages or the aggregates. To go back a step, as our original submission outlined, we went to first principles to understand why we have a CGT discount in the first place and how it sits within our comprehensive income tax system. The tax system gives a coherent vision for what the income tax should look like through a rule of thumb that $1 should be taxed equivalently, irrespective of how it's earned. And the challenge is that $1 of capital income is different to $1 of wage income for two reasons: because some of capital gain is in effect inflation, so it's an increase in the prices of goods and services over time, so it's not affecting real consumption possibilities. Secondly, that realised gains are often irregular and lumpy. So an asset can be realised in a particular year that can push a taxpayer into a higher tax bracket and even lead to some strategic timing of realisation of assets. Those two issues were both canvassed in the Asprey Review in the 1970s. The original design of capital gains taxation in Australia included an adjustment for inflation and the ability to average returns over multiple years. The current capital gains tax discount is effectively a rough approximation of those two factors, and arguably it was introduced at a time when simplicity was a high priority relative to precision and equity and fairness. Our original submission to this inquiry illustrated three basic consequences of applying a uniform discount like the 50%. One is that it results in different effective tax rates on different real returns. Specifically, it taxes high real returns at a very low effective rate, and it taxes low real returns at a high effective rate. Secondly, it doesn't address the problem of lumpy capital gains taxed at a high marginal rate due to the progressive income tax. And third, it effectively rewards high leverage because it allows a discount on taxation on the capital gain, but allows full deductibility of interest, even though the asset holder's debt is actually falling in real terms when there's inflation present. Today, we're sharing some new analysis with the inquiry, as I outlined. What we've tried to do first is to set up or design a benchmark against which the current discount could be judged. And we base this benchmark on our view as to what the tax principles, basic tax principles would suggest should be the taxation of capital gain. So firstly, one that adjusts explicitly for inflation, so it is taxing real returns, not inflation returns. Secondly, that it averages returns over the years that an asset is held. So it calculates the tax at the taxpayer's marginal rate for the relevant year over which the gain occurs, albeit that the tax is still paid on realisation. And it allows deductions for real rather than nominal debt by adjusting each year for the effect of inflation. So we've called that system an ILT neutral, neutral with respect to inflation, that's the I, neutral with respect to leverage, the L, and neutral with respect to timing of the realisation of the gain. And then we can compare what happens under that approach to alternatives such as the current discount and alternatives like a 33% discount and see how they differ. This analysis basically helps us quantify the three key issues that we pointed to in our original submission. The first thing to note about it is there is in the data, there is a very significant variation, a very significant heterogeneity in the real returns achieved by different taxpayers. And that is a big problem for a flat CGT discount because those who are making very high returns, very large percentage returns, are going to be lightly taxed by a flat discount. Those who are making zero real gains, zero real returns, or even low real returns, but some nominal returns, will end up being very heavily taxed by a flat discount. So one demonstration of that is that in this ILT neutral approach that we've put forward, and we've got another alternative that just adjusts for inflation, they impose what look like relatively low median tax rates across both the income scale and the age scale on capital gains, but they tend to raise a lot more revenue than the current discount at 50%, or even a tighter discount, a lower discount like 33%. And that's because the inflation-adjusted approaches raise a lot more revenue from those who've experienced very large capital returns. And so in that sense, it is a much more progressive way of taxing capital gains. Now that result is not a function of the size or generosity of the discount, it is a weakness of using a discount, a flat discount, as the proxy for inflation, full stop. Second, the problem of lumpiness has a very interesting effect. What we see in the numbers is what looks like the strategic timing of the sale of assets in order to limit tax liability. So our work identifies a number of sellers who appear to be waiting for their income to decline, their non-capital gain income to decline before realising a CGT asset. So it appears that that could be mainly in the early years of retirement. A result of that, perhaps unexpectedly, is if we were to move to income averaging, which can obviously act to protect some taxpayers from being forced into a higher tax bracket, it also acts to raise more revenue from those who are waiting to sell an asset in a year of low income. So for that reason, in our sample, this ILT neutral approach actually raises more money than approaches that only adjust for inflation. When we do that income averaging, it actually boosts revenue, it doesn't reduce revenue, even though it's a concession for some people who get forced into a higher tax bracket. Now I emphasise that, these returns could be a bit affected by the sample that we're using. We're using 10 years of data, all on real property, and yeah, for assets sold in the 2022 year, but accumulated in the preceding 10 years. I just reiterate, these issues don't come about because of the current level of the CGT discount. The level's not what's driving these findings, it is the form. It's the fact of having a blanket percentage discount. So reducing the level of the CGT discount to 25 to 33%, whatever, does not fully remove the issues we've identified in this work. It doesn't deal with the significant variance in real capital returns. and the inequities associated with that, and it does not deal with the incentive for strategic timing. It's not even clear that reducing the discount would actually, as to whether that would make the incentive for strategic timing greater or lesser overall. So overall, when we compare what we describe as our ILT neutral approach, adjusting for inflation, leverage and timing, we find that it firstly makes the tax treatment of capital gains much more consistent across individuals. It reduces the incentive to strategically time sales when income is low, and it removes the tax incentive to debt finance and the purchase of capital gains generating assets. But overall, we found in our sample it raised more revenue from capital gains, and it was a much more progressive, I should say a modestly more progressive approach. So it was taking a higher share of revenue from the top income decile than either a 50% discount or a 33% discount, but raising more revenue than both. And just to repeat the point, the problem with the current system is not primarily about the 50% number, but about the use of a single number discount. And to be absolutely honest, if we had no alternative but stick with a single across the board discount, it's not altogether clear that 50% is the wrong number if we're thinking purely in terms of tax principles. On some metrics like the median tax across the income distribution, the 50% number looks closer to our ILT neutral benchmark. It looks further away for the very high returns and the very high income, the top income decile. A significant qualification I should just place on the record is that for consistency, we would make the point that inflation adjustment that we're talking about in the context of capital gains ideally would apply across all capital income. So it would apply to dividends, it would apply to term deposits, where we ideally would not be taxing the inflation component of capital return. And secondly, just a quick point that the pre-1999 system for taxing capital gains included some of the features that we're proposing here in terms of adjusting for inflation and timing through the averaging system. It was deemed too complex at the time, and that's what led to the discount. We would just contend with modern technology and record keeping. The argument for simplicity, whilst it's still important, has just become relatively weaker over time compared with other considerations like the equity and the efficiency in the tax system. So the costs in terms of equity and efficiency of the flat 50% discount have become a bit clearer relative to the case for simplicity. Thank you very much.
All right, thanks very much, Mr. Brennan. On behalf of the committee, I just thank the E61 Institute for the breadth and the depth of your engagement with this issue. You mentioned in your opening submission that you had a subsequent submission to the inquiry. Can I check with you that you would be okay with tabling that today, which would have the effect of pretty much immediately making that document public?
Yes.
Absolutely. Happy with that? All right, thanks. So we'll accept that document, which I believe the
provided to
Secretary...
committee members on an embargo basis.
Yeah, no, that's right. So the Secretary, we do have copies of that, but which the Secretariat is distributing now, and that will be public shortly on the committee's website. I might just lead off with a few questions. I'm sure my colleagues have some, but your original submission makes the case pretty compellingly that the capital gains tax discount is undermining the progressivity of our tax system. I should ask you, would you accept that characterisation?
Broadly, yes. I think that's right.
Yep. Could you just, for those maybe listening who haven't read your submission, could you just talk us through in a high level how that effect is being generated by the CGT discount?
Yeah, and I'll also ask my colleague, Mr. Nolan, to chime in on this. But broadly in the original submission, and in some work that we released late last year at the tax summit organised by Allegra Spender, one of the observations that we made was, as a result of capital gains and the tax treatment thereof, when we look at effective tax rates across the income distribution, we see a fairly predictable pattern and a relatively low variance for sort of low and middle income earners, that there's a degree of variance in what effective tax people are paying for a given level of income. But if we take this comprehensive view of income, where we're taking account of both wage income but also capital gains, at very high income levels, you see quite a significant dispersion of effective tax rates being paid. So you do have some people in top towards the top of the income distribution, paying lower effective overall rates of tax on their comprehensive income. Some of that is driven by the fact that people might find themselves in the top income decile for a year because they've made a significant realisation, say, of a property. But we find that there's a broadly similar pattern even if you take averages over an extended period. So if you're averaging income and looking at people who are in the top decile over a period, there's a greater likelihood that they're earning a portion of their income through capital gain. And the point that we're making in this submission is that the taxation of capital return, real capital return, is highly variable. So whether I'm a low or a high income earner, if I am earning a modest real return, so I could even have a zero real return, but I've gotten some return broadly in line with inflation, then at the moment the capital gains tax discount taxes me quite heavily because I'm paying tax even though I've made zero real income. I've had zero increase in my real consumption possibilities. On the other hand, if I've made a very substantial real return, taxing only 50% of that is quite a significant concession, as opposed to taxing all of it over and above the inflation component, all of the real return. And because there are some significant real returns being earned towards the top end of the income distribution, that is the bit that undermines the progressivity. And that's, as a consequence, we wanted to look at this benchmark of, if we were simply adjusting for inflation, adjusting on the debt side and having this averaging over time to get rid of the strategic timing issues, what we find is that a higher proportion of the revenue is raised from the top income decile than, as I said, a 50% or a 33% discount. So the progressivity to me comes in via that channel. I don't know, Matt, if you wanted to add anything.
Mr. Nolan, yeah.
So I definitely agree with that. I would probably give a brief summation that puts it sort of into 3 points. So when we think about progressivity, we think about the average earnings you have over your life cycle. We're not just talking about during a year. So in the first submission, the idea was very much about income averaging. You would have individuals who have persistently high income. And if we were discounting for income averaging, they shouldn't really receive a discount. But people that have lower income over their life cycle and a sudden spike, there is a rationale for a discount. So for that reason, over lifetime income, we're sort of discounting too much at the top end. The second point is about these real gains. If we know that higher income earners tend to generate higher real gains, which there is some evidence for, that tends to point to the idea that towards the top end will be undertaxing. And then thirdly, we do know capital gains income is very distributed at the top, even on a life cycle basis. And then given that if it is too concessional, which is an open question, that would lead to less progressivity as well. So all three of those channels are relevant in terms of different instruments and design elements of the CGT.
All right. Thank you both. That's really helpful. Could I just pick up on one element there? So obviously the figures show that the benefit of the CGT discount flows in significant part to high income earners, and in part that's explicable by the fact that when people realise the gain, that bumps them up in that year in terms of their income. But from what you said, Mr. Brennan, your evidence is that even if you sort of remove that phenomenon, it is still the case that the CGT discount significantly benefits people of high income.
On high lifetime incomes. Yeah, that's right. I think that's fair, isn't it?
Yeah. All right. Thank you. So your colleague, Mr. Kaplan, has said that the absolute worst case you can be in is to earn all your income as an employee working for somebody else. And Mr. Brennan, although your language is very different, you alluded to the relative taxation rates in your opening statement in regards to income tax versus tax on capital gains. How do you see our tax system from a very high level in terms of the way that it taxes income that people earn from going to work every day versus income that people make from buying and selling assets?
So Greg Kaplan is our board chair, so I'm an employee of his. I'll have to.
Well, I don't mean to place you in a difficult position, Mr. Brown.
But yeah, I think the point that he makes is well made in that I bring it back to this issue of neutrality. What we're trying to get at ideally, and this is outlined in the Asprey review before we had capital taxation in Australia, or capital gains taxation in Australia, when they were sitting down to think, what would this look like if we believe this is part of the comprehensive income tax system? It should be neutral as neutral as possible as between capital income and other forms of income, including wage income. And the way you would do that is you would adjust for inflation and you would provide some allowance for timing, for averaging over years. I think what drives the problem that Greg's pointing to is this issue of non-neutrality, that there are circumstances under which you can, if you can effectively at the margin substitute what would otherwise be wage income for something that looks more like capital income, and you're making a reasonably significant real return out of that, then the discount will be pretty kind to you, because you don't get a discount on your wage income, but you will get a discount on the capital income. And I think that the broader point that Greg's making is it's not obvious from an economic point of view that we get more dynamism, innovation, entrepreneurship, etc., always by having people buying and selling businesses or going into business. A lot of that will happen through an employer-employee relationship. There's a lot of innovation and dynamism to be unlocked within an employment structure as well. So, we shouldn't be too binary about the idea that if we want to encourage innovation and dynamism, we have to be artificially encouraging, say, capital income or business formation, as opposed to an employment relationship. We'll have some other research in coming weeks about what has been effectively a decline in self-employment. Part of what we see going on there is that a lot of the returns to talent, to risk taking, to innovation are now happening within the employee relationship, and you want to be reasonably neutral between those two.
Thank you. Mr. Nolan, I believe you've said in the media, and you will correct me if I paraphrase you incorrectly, but I believe you said that the existence of any discount rate, whether it be 50%, 33, 25, whatever it might be, will still have an inflationary effect on house prices. I'll pause there to see if you want to rebut my characterisation of what you've said.
So I think it was probably framed slightly differently, but these things can come off in certain ways. The idea here is that no matter what the discount is, unless it's zero, we're giving an allowance for some income, but we're not doing anything on the debt side. So it gives an incentive for people to leverage up, to borrow more in order to purchase property. Now, what that means for house prices and the such is something we haven't looked deeply into. So we were just very much making the point about leverage and that those non-neutral incentives exist, but we couldn't speak to numbers or what the effect would be.
No, but leaving sort of specific numbers aside, just on an in-principle level, what you're suggesting that the existence of any discount would increase demand for housing stock in Australia, and thereby, all other things being equal, prices would go up?
Yes, but I would also say it a bit more generally. Not treating income and expenses consistently or symmetrically in any structure will lead to that. So in a lot of other countries, they have systems that do give a more concessional treatment of capital gains, but they make sure that expenses are also treated in an equivalent way, such as through a lower rate system of dual income tax. In that specific quote, it would have been a discussion about the specifics of the discount, but there are many ways to skin a CGT. So I would probably leave it there.
All right, thanks. Mr. Brennan, you do have a background in productivity. I think that's fair to say. I want to ask you whether the CGT discount, and I'm not asking specifically in terms of numbers or rates of the discount, but does the CGT discount specifically, and highly elevated land prices more generally, does that have an impact on productivity in Australia?
It'll surprise you to know, Chair, it's very hard to say, I think. And it's hard because with all of these policy levers, it's very difficult to identify a single lever that we can say has a specific effect on measured labour productivity growth or total factor productivity growth. The sort of channels that you'd be looking at, I guess, if you were worried about that, are, again, the tendency to non-neutrality. Are we effectively taxing some things more generously than very similar alternative activities? So, for example, as we mentioned, taxing wage income more heavily than some forms of capital income. The leverage point that Mr. Nolan mentioned earlier. All of these things, if you allow these distortions to grow and influence behaviour a lot, there is a risk that you will find investment being channelled into less efficient or less productive areas. I'm perhaps more so than most a little wary of blanket assertions that housing is unproductive, or investment in housing stock is unproductive, kind of by its nature. I think that it's not a. I don't think there's a strong, familiar sort of economic concept of what's a productive investment versus what isn't. But I think, again, I just keep coming back to the point about neutrality and equity across like activities, and are we taxing in accordance with first principles, not giving a particular artificial leg up to particular approaches.
All right, thanks. Back in the sort of halcyon days of high productivity, maybe like, for example, the 1990s, like banks lent about twice as much to business as they did to property, and that's completely the opposite now. Banks lend about twice as much to property as they do to business. Is there a correlation between the high productivity of the 90s, that data, and the current productivity slump that the country's in?
So there's a correlation, whether there's a causal relationship. I think, and if there was, the causal relationship could operate both ways, so it's always difficult to know. But it is an interesting phenomenon. I agree that the patterns of lending have moved so heavily in the direction of residential property, and a number of things get put forward as to reasons for that. So, prudential regulation and the risk weightings that apply to different forms of investment. It is possible, and I want to be very cautious about this, but it is possible that the non-neutrality that we've talked about, Mr. Nolan just referred to in relation to debt, does operate a little bit in favour of residential property, because it might be easier to secure debt against a real property asset, and so a tax system that is encouraging of leveraging might, in a de facto sense, be a little bit more pro real property. But again, I just want to be a little cautious because I don't have a clear empirical basis for saying that. But it's an interesting phenomenon, has been commented on, and is that totally unrelated to our productivity challenges? Probably not. Yeah, there's probably some connection in the kind of where debt and equity capital are flowing, and overall productivity performance. Albeit it's always difficult to find smoking guns for these things. Yeah.
Love the caveats of economists, and
former
bureaucrats. By the way, they're totally reasonable and fair enough. Thanks. I'll ask Senator Dowling, or I'll give Senator Dowling the call.
Thanks, Chair, and thanks for the evidence and the new modelling. It's very helpful. I think one of the questions we've had all along, and we've had a lot of submissions present, that this timing issue of the early 2000s, we saw a significant rise in house prices across Australia, and that coincided with a change in the tax arrangement, specifically capital gains tax 50% discount, potentially working in concert with negative gearing. I haven't yet been able to get an explanation of how that also explains how other house prices in advanced economies globally also spiked at that time, United States, UK, Canada, New Zealand. Do you have a view on that, and to what extent we can just pinpoint the house price affordability issue as starting because of that change or just coincidental?
Yeah, I think even if it's not coincidental, it's just a question of how much of the overall trend is driven by that tax change. You're right, it was partly a global phenomenon, and I think two other important things one global and one domestic that were happening at the same time, which are bigger than the CGT change. So the first is that there was an adjustment to a lower inflation world, and so a locking in of expectations that interest rates would be permanently lower than they had been in the past. And that, it seems to me, had a very significant one-off effect on the level. When I say one-off, it took a while to flow through, but it was a level shift in property prices or asset prices because the borrowing costs and the rates at which the future flows from those assets was being discounted was much lower. And that was a reflection of expectations about inflation, renewed focus on inflation targeting, the fact that in most developed economies inflation had come right down from the early 90s, and greater confidence of central banks and policymakers to control it. I think that was significant. The other thing that happened from the early 2000s that's more specific to Australia is a very significant rise in real incomes as a result of the terms of trade boom that started from around 2003. Led by the iron ore price and the development of China, and that, you know, increased real incomes. We also had significant population growth at the time. I think that is also something that contributed to the run up in housing prices a bit in that period. So I think it would be brave to attribute even a material portion of the run-up in house prices to this tax change. But it's not to say that even if the tax change is kind of found innocent of that, doesn't necessarily mean that there aren't weaknesses with the discount.
Yeah, okay. What lens should we really be looking at this through? Because you've sort of presented inequity across and taxing different dollars differently, whether it's labour income or capital income. What is sort of horizontal equity the right lens? We've sort of, I think politically, that there's a view that this should all just be about a housing discussion, but clearly that has much bigger implications. What is the right lens when thinking about tax principles that we should be thinking about how to design this?
Yeah, so I think it's the right question, and I would say it is the twin principles of horizontal and vertical equity in the tax system. So I would always come back to, why are we trying to tax capital? What are the principles we're trying to use? How does this system stack up against those? Look at the departures, and then you can kind of quantify how important those departures are. So the horizontal equity argument, the idea that you want to have people with like or similar incomes taxed equivalently. Vertical equity in the sense that we've got a belief in progressivity, that those on higher incomes make a higher proportionate contribution to revenue than those on lower incomes. For me personally, and I note that a lot of the evidence before the committee has focused specifically on the housing issue, or it's talked about intergenerational issues, etc. I would downplay those as the lens through which we should see this issue and play up the tax principles, the neutrality, the horizontal and vertical equity considerations.
We heard from the Tax and Transfer Institute yesterday, Dr. Brunig, and he sort of presented a chart which shows, even if you sort of made some corrections to the way the CGT discount operates, we still would have vastly different effective marginal tax rates for a whole different bunch of assets, whether it's income from rents, from capital gains in property and shares. So just by making an adjustment to this one feature of the tax system, we wouldn't really be able to neutralise horizontal equity anyway, would we?
That's fair. Yeah, I think hence what we're saying here is you could have a more neutral treatment of capital returns, raise more revenue, but of course if you were being truly neutral, you would deduct inflation from things like term deposits, dividend income, etc., that would cost revenue. And I agree with Professor Brunig's point. And the TTPI has put out work in the past that shows just how different the effective rates of tax, which are also hard to calculate, but how different they are on owner-occupied housing, which is heavily concessional, superannuation, which is pretty concessional. Investor housing, it's not clear that it's like massively concessional, certainly not compared to those other two, but it certainly is relative to a term deposit. And yes, I think it would be preferable if we had a more common approach to capital taxation across the board. I guess one observation I would make is I think a more neutral. So you're right in one sense. You could improve this, reform it, go for something more like what we're proposing, and still have quite an inequitable or quite a messy treatment of different forms of capital income. But I think it would be a better platform from which you could then make adjustments in the future. For example, as Mr. Nolan said, make some allowance in relation to term deposits. I think an explicit inflation adjustment is an easier starting point to do that than a blanket discount.
Yeah, okay. Just on that point, it was actually interesting. We heard from the ATO that potentially the indexation method, it wasn't actually that difficult as it's now sort of historically people are saying it was removed before simplicity. It was very hard to administer, but that's not necessarily the case that it was that hard back then. You know, we had calculators, we had inflation tables. Do you think it was actually that complex to begin with?
Yeah, it's hard to imagine that it was that complicated. I think the income averaging maybe was a little more complicated because it would require that you maintained records of income over time, but of course that's now much more digitised. So I agree. I think there's often a difference between conceptual simplicity and administrative simplicity. So the 50% discount is conceptually very simple. Whether it was massively more administratively simple than the existing system, not necessarily so sure. Yeah.
Just in this second note you've submitted this morning, I think it uses short-term housing data. Whereas I think your first submission was more economy-wide focus. We haven't heard a lot about the impact of trusts in the capital gains discount. Do you have a view about how distortionary that could be? Because some have suggested that actually has even greater distortions.
Yeah, it's an area that we're intending to do. I'll get Mr. Nolan to comment on this, but it is an area that we're looking to do a bit of further work on, because there is some ability to look at trust distributions in the anonymised tax data, and there would be some ability to look at the interaction between trust structures and capital income. Matt, did you have anything to add?
Only a small amount. So we haven't done any work on trusts yet, but trusts were a big issue when the Ralph review occurred and when they talked about what was happening with capital gains, and was the big reason why they justified simplification is because things were being channeled through and used in trusts in order to time returns and to spread them across the household. Now with a capital gain, that is in a sense shared across a household, and there's a broader principle about how do we think about income? Do we think about it on a tax basis on a household or an individual level? So whether it's a bad or good thing is very much in line with that principle. But trusts can be used for people to shift who recognises the capital gain and the tax treatment of that. So any reform to capital gains does need to take trust seriously.
Okay, that's helpful. Thinking about capital mobility and efficient allocation of capital, we hear a lot about, obviously, transaction taxes, stamp duties, that they obviously are very inefficient. But would your evidence also be pointing to the fact of this strategic timing issue also potentially incentivising people to delay what might be an optimal reallocation of their capital, but for the design of the tax system, they're not proceeding with that?
Yeah, on the face of it, it does appear that way, and it probably surprised us looking at the data, but it's the data that's effectively summarised in Figure 5. You just observe how stark that, the year where capital income rises, non-capital income falls. And, again, the causation might be running a bit both ways. people might have mechanisms to reduce their non-capital income in the year that they always intended to realise the asset, but it's quite likely that they're just realising the asset in a year that they were otherwise not going to earn as much money, including early in retirement. So that could be a feature of the system that is encouraging a degree of lock-in, that in a way a pure sort of system of capital, taxing capital returns shouldn't really do. It shouldn't really be, unlike a stamp duty, which is clearly biased against regular turnover. A capital gains tax shouldn't really be biased against regular turnover, but this points to a possible friction, as you say.
Okay, thank you. Thanks, Chair. I think Senator Whittaker might have had a couple of questions.
So what I might do, Senator Whittaker, I'm aware that Senator Bragg's here, so I'll go to Senator Bragg and then I'll come to you. So Senator Bragg has joined us by teleconference, and he does have some questions. So give the call to you, Senator Bragg.
Thanks, Chair. Well, look, thank you very much for being there today. I wanted to take you to this issue of it's been an interesting committee to be a part of, because it has been looking at a tax measure in detail. But of course, this tax measure is connected to other things. And it strikes me as very strange that so many of the submissions have not looked at the supply equation. Also, many submissions have kind of written off investment in housing as being unproductive, which strikes me as very odd and a bit tone deaf, frankly, given that we have a significant supply challenge here in Australia when it comes to housing. So do you have a view on whether investment in housing is productive or unproductive?
Thanks, Senator. So yeah, I did make mention of this earlier. I'm a lot more reluctant to make that claim than some. It doesn't appear to me that there's a clear distinction that can be made between particular types of investment as being productive or unproductive. And as a result, our submission is, and part of the reason our submission doesn't and wouldn't go to issues of, say, housing supply, is that we're really viewing the issue of capital taxation not through the lens of what it does to housing prices, what it does to the housing market, but just through the principles of, kind of as you're implying, what are the linkages to other areas of the tax system, including the taxation of other forms of income. So it's much more focused on just what is a more neutral approach to taxing capital income that's consistent with the comprehensive taxation of income across the board.
Yeah, so I imagine the view of E61 is that supply is paramount in the housing debate, right?
Yeah, well, it's of great importance. I mean, it may not be the only thing, but it's certainly probably the biggest factor, and it's certainly more supply is helpful. One would think if the aim is to achieve more affordable, more accessible housing, then yes, supply is, I would imagine, the number one priority.
I mean, isn't the basic point that we don't have enough dwellings in Australia, so we need to build more?
Yeah, I think that's largely right. It's not to say that there aren't other things that are influencing prices that aren't just about supply. I mean, this goes a little bit to Senator Dowling's earlier question, but it is the supply-demand imbalance obviously would also flow through to rents, observed rents, and rents as a share of income in Australia have moved a little bit sideways over the long term, but the ratio of prices to rents has risen a lot. And so that does tell you there's something going on kind of on the asset side, and it could be that expectation of lower ongoing interest rates, for example. But yes, the supply-demand imbalance will obviously be a critical determinant of overall housing prices and certainly rents.
So, I mean, overall, the way that I look at the housing system is that it is already heavily taxed. Certainly, it's burdened by a lot of regulation. I know that E61 has already done significant work in this field of looking at the red tape in the housing system. But I mean, it is already a heavily taxed and heavily regulated sector, isn't it?
Some parts yes and in others no. So owner-occupied housing is not heavily taxed in Australia relative to other forms of savings. There is some evidence, there's some OECD evidence to suggest that investor housing in Australia is more heavily taxed than sort of an OECD benchmark or average, and that's largely because of stamp duty and land tax. And I apologise that this is an unsatisfying response, Senator, but the answer, as always, is it depends. There are some forms, you know, if you think about the point we're making in this submission about the neutrality between wage income and capital income, take the example of a housing investment, which is essentially about purchasing a property, putting substantial work into it to improve it and then flipping it subsequently and earning a significant capital return. The point we would make in the context of this submission is that activity probably is undertaxed in Australia, because what is going on is a fair bit of labour input aimed at making quite a high capital return, which the 50% discount will kind of undertax relative to earned income. And so that sort of activity, I would say, is probably lightly taxed. But there would be other housing investment where, you know, particularly if you're not making a particularly significant real return, where the 50% discount is not particularly generous and could be very ungenerous.
Yeah, and do you think there's a risk that if the tax concessions were reduced, that you would have a situation where rent could increase?
I've done no work on that, so I wouldn't feel qualified to make a prediction of the impact on rents. Okay. You know, I guess the question is still about. I see this less as whether to make this more or less generous. I think at the moment the problem we're pointing to with the 50% discount is it's too generous for some and it's not generous enough for others, and so it's not about overall generosity. It's about the distortions that it creates.
Yeah, I mean, your submission makes a lot of good points. You know, I think some of those broader neutrality points are going to be very hard to fix in the short time we have for this inquiry, but you've made a lot of good points. So, look, just in the interest of time, I do want to also ask you about the debate about tax concessions from the tax expenditure statement. I mean, this is a one-dimensional view of a tax concession. If there are changes to tax policy, it doesn't mean that revenue is banked by the Commonwealth, does it?
There's a challenge always in estimating quantifying a tax expenditure, because you have to take into account, ideally, you would have to take into account behavioural changes. But the other point about a tax expenditure is you have to have a clear benchmark. So if you think the benchmark for judging a 50% discount is a world where there's no discount, then it's a concession and it's 50%. I think the point we're trying to make in this submission is the appropriate benchmark would be something that is neutral as to inflation, leverage, timing. That is the best benchmark against which you could judge the 50% discount. On that, you know, we think the 50% discount is less progressive, raises less revenue, distorts timing, all of those things.
Sure, but if someone says, look, the tax expenditure statement says that $20 billion is so-called, using inverted commas here, you know, spent, I mean, you know, that isn't money that could just be spent on something else, because it might not exist if there's a tax policy change and behaviours change. Isn't that right?
I agree with that.
Yeah. So effectively, if you want to have a more sophisticated debate, as I can see you want to have, I mean, the idea that you can solve the nation's housing crisis by fiddling around with these tax concessions and, you know, so-called, you know, reallocating the money to something else, I mean, it doesn't seem to be a credible way of solving what is a very complicated problem.
Yeah, and in a way I won't comment on what impact it would have on housing and the housing market specifically, because it's just not where our submission's been geared. As Senator Dowling's question sort of elicited, we think the lens to look at this is tax neutrality. What's the right design that maintains the right comparability with other forms of earned income, for example, not necessarily what's the impact of this measure on housing or on intergenerational equity or any of those questions.
Yeah, so just finally, Chair, thank you for your indulgence. So my reading of your submission is that you're effectively saying, you know, a lot of the things that Ken Henry said 15 years ago made a lot of sense, that we've got a spaghetti bowl of tax rules and regulations in Australia, and that we ought to have a more uniform, less distortionary approach.
That's true, yeah, across forms of capital income, but also within the taxation of capital gains, yes.
Yeah. Thanks for your evidence.
All right, thanks, Senator Bragg. Senator Whittaker.
Thank you. I just have a couple of questions. I think your submission and this additional information you provide us today has sparked, I think, an interesting discussion here about perhaps some of the motivations to Senator Dowling's question about, like, what is the principle, what is the lens in which we're looking at making these changes, and that might impact what you do. There's been lots of discussion over the last couple of days of our hearings about the distributional impact of the CGT discount as it relates to people who receive the discount and people who don't. What I think is particularly interesting about what you have taken us through today is that actually that distributional impact exists within the cohort of people who receive the discount. And I think it's worth us hearing from you in a little bit more detail about that, because I think that's an important consideration in thinking about what might happen from here.
Yeah. So I'll get Mr Nolan to talk through a bit of the detail of this and what the degree of variance, heterogeneity that we observe within the cohort. As we said before, it's not totally unrelated to the point. So there are 2 points you're making. Yes, higher income earners are more likely to realise an asset. That's true. It's also true that those who are realising assets with significant high capital returns are more likely to be high income earners as a result of that fact. So to some extent, yes, you can look at this at a kind of what we'd maybe describe as the extensive margin, the idea that those who use the capital gains tax discount tend to be higher income households, therefore anything you do to make it less generous is ipso facto more progressive. I guess what we're looking at, as well as what we call the intensive margin, looking within the capital gains tax discount, what are the progressivity implications of it, the way it's structured, and that's where we get to this point about is it figure 6 or 7? That's like comparing the revenue raised, figure 8, sorry, comparing the revenue raised under different alternatives from different income deciles. And it's perhaps surprising, you know, that a 33% discount actually raises a smaller share of revenue from the top income decile than the sort of approach that we're thinking about. So it is this point that to take very simple numerical examples, you know, if you're making a modest real return or a zero real return even, but you're making some nominal return because of inflation, under our benchmark that shouldn't really be taxed at all. You've got no real income increase, you've got no improvement in your real consumption possibilities, but under the 50% discount you will be taxed. You'll be taxed half of that inflation component. On the other hand, if you make an astronomical real return, we're saying that you really should be taxed on all of that astronomical real return, not just half of it, because the discount as it currently operates will tax you for half of the inflation amount and half of the real return. And for very high returns, that's pretty concessional and potentially distortionary. But Matt, did you want to comment a bit more on the variability?
I think that's 99% of it. But we're proposing a capital gains tax that treats capital gains like their wages, is one way to view it. So if you had $100 and then the price of everything went up by $3 and your asset went up by $3 as well, by 3%, then nothing's happened. But if your asset price went up by 6%, you made a 3% real return, the current discount looks like it treats it perfectly. If it was 8%, your real return's even larger. The discount's overcompensating people. And that's the tension that Michael was very much talking about. But that equivalence really does need to hold across the whole tax system. We talk about a lot with capital gains, but you could say the same thing with $100 of a term deposit and making a 3% interest rate. Yeah.
I guess one of the things we've heard a bit in recent days to that point about treating a capital gain in the same way that you're treating income, well, one of the arguments that has been put to us is that income tax rates aren't adjusted for inflation. And so I just wonder what your views are on that kind of tension.
I might just quickly take that first. So income tax rates are for both wage earnings and capital earnings. So the lack of an adjustment for bracket creep ends up passing over to both. But what's happening with capital income tax is you also have this inflation component that's maintaining the value of the asset. So when you receive part of your interest that just reflects inflation, it's just keeping the term deposit you have or the capital item the same real value. So it's maintaining its value. So we can think about it like a depreciation deduction when we give it away. Now, to make it equivalent to wages, if we were going to tax that, we should not just be taxing your wage, but we should be taxing the increase in the wage you received in the year. So currently it's not that bracket creep is just about labour earnings. It's affecting labour and capital, but then there's another inflation component for capital on top of that.
That makes sense. Thank you. Thanks, Chair.
Thanks, Senator Whittaker. Thank you to the representatives of E61 for your engagement with this inquiry, and to you, Mr Brennan and Mr Nolan. Thanks very much for taking the time to come along and give evidence today. That concludes this session, and the committee will suspend for 15 minutes. Let's say resume at 10:55. the committee will recommence with representatives from the Australian Council of Social Services and National Shelter. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full names and the capacities in which you appear today? We might just run down the table if that's okay.
Good morning. My name is Thomas Chailloux. I'm appearing here as the lead author of National Shelter Submission. I'm the Senior Policy Officer at Shelter New South Wales.
John Engler, Chair of National Shelter.
Dr. Peter Davidson, Principal Advisor, ACOS.
James Hall, Senior Advisor, ACOS. Thanks.
Well, thank you all for your attendance today. If any or all of you would like to make a short opening statement, now would be the time. I might see if Shelter has an opening statement to start with. Thanks, Mr. Engler.
Well, thank you for the opportunity to appear at the Senate hearing. Shelter's been going for over 50 years advocating for people on low and very low incomes to get them more secure housing. So, of course, we'd like to begin by acknowledging the traditional custodians of the land, the Gadigal people, and I'd like to pay my respects to elders past and present. Australian values include fairness and equality of opportunity. We often call this a fair go. This is not just my personal opinion, it's in fact officially recognised by government in the Australian Values Statement. So the current structure of the capital gains discount affects both of these. It's unfair for three main reasons. First, it taxes capital gains. In other words, wealth. That wealth is taxed inadequately when we compare that to labour, hard work, sweat. Secondly, it overwhelmingly flows to high wealth and high income households. So in 22-23, 86% of the benefit of capital gains flowed to the top 10% of income earners. Thirdly, it overwhelmingly flows to men and older households. People over 60 received 52% of the benefit in that same 22-23 year. So it also affects equality of opportunity by increasing property prices, preventing a significant number of people, particularly young people, from accessing home ownership. So as we've heard today, the original rationale for the discount was to provide a simple method to account for inflation. But the current discount of 50% goes far beyond that. At the average inflation rate of 2.5% per year, it takes about 16 years for an asset to increase in its nominal value by about 50%. Assets sold within a shorter period, such as the median investment property are now, about 8.8 years, therefore tend to be undertaxed compared to even that inflation-adjusted method. So the CGT discount also has negative effects on productivity and house prices. Because it enables tax deferral and minimisation, and investment in residential property is greatly attractive to higher income households. When we combine the operation of the CG discount and negative gearing, it allows high income, high wealth people to outbid prospective first home buyers and people on ordinary incomes in that housing market, inflating those housing prices. So last September, for example, investors accounted for 40% of all dwelling loans, and they overwhelmingly favour existing dwellings, which represent about 80% of all investor loans. So this clearly weakens the argument that negative gearing and CGT necessarily support, or the discounts that are provided necessarily support new supply. So houses aren't productive assets. Over-concentration of investment in residential property, including from most banks to residential mortgages, is damaging the much-needed productivity gains the Australian economy must make. In addition to this, housing affordability pressures mean that people on low and moderate incomes, health and well-being is affected, and productivity produced in a secondary way, if you like, through overcrowding, longer commutes, or consuming housing that is otherwise just inadequate for them. It also represents that significant macroeconomic risk. The ratio of household debt to disposable income was, in September, 176%, at the time one of the highest in the world. In conclusion, the current discount undermines both that fairness and the equality of opportunity, those two core Australian values that many of us hold dear. So it is time to level the playing field. Challenging the status quo is hard and always triggers a reaction, particularly around subjective things such as housing. But measured reform of housing taxation settings is possible and indeed much needed. So we've got four great things that we ask for at National Shelter. I'll sum them up very quickly and then finish. That capital gains discount be reduced progressively to 25% over 5 years. Negative gearing be limited to income from the same asset class. That the additional revenue unlocked by the Australian government then be invested at scale in social and affordable housing, and some stronger prudential regulation to limit the ability of investors to take overly risky amounts of debts. This should also be thought of and increased. So we expect these reforms to rebalance the housing taxation settings to give first home buyers that fair go. and moderate price growth can still occur without overly impacting property values. More importantly, these reforms will free up revenue from all levels of government to invest in that non-market housing, the real time-proven solution to the housing crisis. Thank you for your valuable time in considering this issue.
Thanks very much. Dr Davidson, did you have an opening statement?
Yes, thank you, Chair. And I also would like to acknowledge we meet on the lands of the Gadigal people of the Eora Nation and pay my respects to elders past and present. Senators, I'm having a Groundhog Day moment. Along with Professor Evans, ACOS was one of the few to call out the likely impact of the 50% CGT discount, together with negative gearing arrangements, on home prices when it was first announced. Yet here we are 27 years later and those arrangements remain in place. The CGT discount and negative gearing have reduced home ownership, deepened inequality, weakened productivity, increased household debt and heightened macroeconomic risks. Of course, the CGT discount is not the only cause of those problems, and reducing it is not the only solution, but it's an important part of it. Our primary recommendation is to reduce the discount to 25% across the board for all CGT assets, phased in over 5 years, keeping the reform as simple and impactful as possible. Another option to consider is to replace the discount with a system of inflation adjustment, but one would also need to consider extending that to other investment income, as E61 indicated earlier. We also advocate curbs on negative gearing for assets attracting CGT. There are 4 good reasons to reduce the CGT discount: public revenue, tax policy coherence and integrity, equity and housing affordability. Now, most witnesses have focused on the housing side of things. Just to be different, we're going to reverse the order, and James will speak to equity and housing affordability. Turning to public revenue, the CGT discount cost $22 billion in 22-23, more than twice the money spent by the Commonwealth on direct housing assistance for people with low and modest incomes. Together with our proposed curbs on negative gearing, our reforms would raise almost $20 billion over 4 years, enough to build 35,000 to 50,000 social housing dwellings. If, on the other hand, existing CGT assets are grandfathered, experience with the introduction of CGT in 1985 suggests that very little revenue would be raised over the medium term due to lock-in effects. And we're happy to provide those data if that would assist the Senate. It's rather difficult to find historical data on CGT revenue that goes back that far. Similarly, restricting reform to rental property and to those who hold more than one rental property would substantially reduce its revenue and other impacts. Turning to tax policy principles, a widely accepted principle of tax policy is to tax investments consistently unless there's a good reason not to. The CGT discount privileges speculation in asset values over productive investment, as we've seen in the housing market. The loss of economic efficiency is not confined to housing, however. While half to 2/3 of taxable capital gains come from rental property, at least another third comes from shares. Gains from speculation in asset values, whether shares, crypto, collectibles, as well as land and housing, are concessionally taxed. This opens up tax arbitrage opportunities and distorts investment. Speculation in land is obviously unproductive, as is the overemphasis among large public companies on boosting their share values, which form a major part of executive salary packages. Share values shouldn't be confused with investment, and the share market shouldn't be confused with the real economy. We recommend reducing the CGT discount across all asset classes to improve tax consistency, and to remove incentives for speculative, unproductive investment. And I'll hand over to my colleague.
So a third reason to curb the discount is to promote equity. The CGT discount contributes to growing wealth inequality. The wealthiest 10% of households now own 2/3 of the value of investment property and shares, but 83% of the CGT discount expenditure goes to the highest 10% of income earners, whose average income is over $250,000, and this isn't only due to the lumpiness of those gains. There is a case for a lower tax rate on income from longer held assets compared to wages to avoid excessively taxing gains arising from inflation, but the discount goes too far. It provides a 23.5% tax rate for well-off investors that's far below the marginal tax rate of average full-time workers at 32%. On housing, the CGT discount has contributed to home prices rising 3 times faster than wages since 2000. In that time, you can see that key home price booms have been led by spikes in investor borrowing. Research suggests curbing the discount and negative gearing would reduce increases in home prices by 1 to 4%, and we think the impact is closer to the upper end, to around 4%, because the standard user cost models don't account for the impact of speculative landlord behaviour. Importantly, a 4% reduction in prices would be a similar impact to the federal government meeting its supply commitments to build 1.2 million homes if it does meet those commitments. Demand for housing moves very quickly, while supply can take years to catch up. And we can't make housing affordable just by boosting mainstream supply. The type of supply matters, and we must also curb the speculative demand that is fueled by the CGT discount. Spending even a fraction of the revenue raised on social housing would increase supply of rentals, and for people on low incomes where the need is most. We propose a 5-year phase-in to smooth changes in the housing market. This is better than grandfathering, which would incentivise both a surge of investment before the reform starts and also lock-in behaviour where people hold investments for longer, which dilutes the several positive impacts of reform. I'll hand back to you, Peter.
And I'll conclude very quickly. Reform of taxes on investment is hard. The opportunity to do so doesn't come often. A government undertaking such reform should make sure it's worth the effort. To have a real impact, the reform should raise substantial revenue and have enough scale to improve equity and change market behaviour. Reform should be as simple and pragmatic as possible. Capital gains are lumpy. Policy decisions made now will impact tax rates for a decade or more. If we try and fine-tune CGT concessions to meet detailed social and economic objectives, there's a danger that we engineer complexity into the system without achieving those goals because the reform lacks the scale that's needed. Tax treatment of capital gains is inequitable, inefficient, and it contributes to the unaffordability of housing. Reducing the CGT discount is not the whole answer, but it's an important part. Thank you.
Thanks very much. I'm going to let Senator Dowling lead us off.
Thank you, Chair. Thanks for the submissions. I think we've seen from a lot of witnesses who've appeared so far that their recommendations and policy proposals are very much framed in the lens that they're coming from, and I think you both have a similar view. But to National Shelter first, I think you've said it. You've raised the issues of housing affordability and inequality as part of the consequence of the discount. What is your primary objective in looking at this tax measure? Because we've heard from sort of the economists earlier that horizontal equity is sort of a key principle for them, but others have pointed to intergenerational equity, housing affordability. What's really the lens that you're approaching this issue from?
I'll defer to my colleague Thomas, who's our policy expert. Generally, the lenses we need to look at are simultaneously, in broad terms, as I heard your earlier questions. You can't divorce the social lens, and I thought we even heard Bernie Fraser talk about that yesterday here, and the economic lens. No matter which lens you use, we would say when you add the temporal lens to that, when you add all three of those, it's difficult not to see that the issue for tax reform around negative gearing capital gains is not an urgent issue. But I might ask Thomas to refer to a bit more of that.
I think our focus is very much comes from an equity and housing justice perspective. So when we look at different treatment of housing taxation, one of the things I want to do is, first of all, we'd like to take some demand out of the market, and that demand is the demand from property investors that get, as you've seen from earlier witnesses, lower effective marginal tax rates. They're able to tax minimize and tax defer, and therefore they are able to beat other people at auction. So what we'd like to see is to level the playing field, ensure that first home buyers get a fair go, have a bit more of a chance when they go to auctions at competing with those investors. We'd also taking some of that demand out of the market, but also increasing revenue. Increasing general revenue for government is obviously a good thing, as it allows government to deliver more services from an equity perspective and a social justice perspective. But what we'd like to see being done with that revenue is even a fraction of the additional revenue, and my colleagues from ACOS have mentioned the numbers earlier. If it was invested in social and affordable housing, this is the real time-tested solution to the housing crisis, because you can control the rent, you can control the eligibility, you can control the housing outcomes for people living on very low and low incomes. So this is our proposal. It's not just about leveling the playing field from a tax perspective, it's also about generating that additional revenue so we can invest in the real solutions to the housing crisis. In the last 20, 25 years, we have relied very extensively on the private rental market to make house prices fall or stay stable. The evidence shows that this does not work, or if it works at the margin for people on moderate income. It does not work for people on very low and low income. So that is very much our perspective, which is rooted in equity and housing justice, both within generations and between generations.
Thank you. So if you argue that the discount distorts investment toward speculative or investor housing, do you think that the system should have been neutral across asset classes, or is it appropriate for tax policy that essentially actively discourage investment in existing housing or other assets, and what principle would justify that differential treatment?
We would say neutrality is desirable, partly because we don't know what will happen in future. I mean, up until now, speculative investment in rental property has been the primary problem here. In future, it could be speculative investment in equities or leveraged equities, borrowing to invest in shares, crypto, whatever. It's very hard to fine-tune these things to achieve the behaviour you want, and to resolve. We don't want to focus too much on resolving yesterday's problems and ignoring the ones that may emerge in the future. Best we think to tax different forms of investment as equally as possible, unless there are good reasons not to. So with super, for example, the good reason is people are compelled to save for a long time, right? But as other submitters have pointed out, there are vast inconsistencies in the tax treatment of different assets. And horizontal equity is kind of undervalued, I think. We often find that the tax policy that improves consistency in the treatment of investment and the treatment of different investors and wage earners benefits both equity and economic efficiency at the same time. That's the ideal.
If I can add two quick points. So if we think about the other objectives of our reforms in terms of reducing wealth inequality and raising revenue for services that we all rely on, the wealth inequality exists across these asset classes, so not just in investment property, but also in shares. I mentioned that stat about the top 10%, the wealthiest 10% of households having that large proportion. So by applying it across all assets, we're addressing these inequalities across asset classes, and also that the revenue raised, if limited to housing, would be less. Around a third or more of the capital gains that are taxable are from shares and non-housing assets. So in addition to the reasons just mentioned, I think the inequality and revenue reasons are ones to have it applied across all asset classes.
Thank you. So capital gains currently they're taxed on realisation and not on, I guess, an accrual basis. Do you think part of the inequity is just that from the discount is from the 50% discount itself, or from that fact that we realise it at a particular point in time? And so would you, even though you've sort of just suggested reducing the discount on equity grounds, would there be a case to actually look at more on an accrual basis and as people are annually realising the gains over that period of time?
I'll respond quickly to that one. As the E61 research shows, a 50% discount and even a 33% discount is more generous for the top end than what they posit as the ideal model of taxation of capital gains over a lifetime, so to speak. So hence we advocate a 25% discount. Now, one could consider inflation adjustment and averaging. The information requirements are pretty substantial, and that's one of the reasons that hasn't been done. But I think the bigger issue here is that other forms of investment don't have that treatment. If you applied it to capital gains only, you maintain the distortion, right? And so, as E61 have just argued, you would ideally extend that same accrual-based treatment to all forms of investment income, including bank interest and so on. If one was to go down that track, the revenue implications would be pretty awful for governments, frankly. And just moving to inflation adjustment without averaging would probably not raise much revenue at all compared to the 50% discount. So whichever way you turn, there isn't a pragmatic ideal solution. We think halving the 50% discount is probably the better option of a series of suboptimal alternatives.
Just to add to this briefly, it's not only the discount that is an issue, it's also the interaction with negative gearing, as we've argued in our submission, because not only the discount and negative gearing allows people to minimise their tax by lowering their effective marginal tax rate, but it also allows people to defer their tax. So in a sense, they are getting a 0% interest loan from government because they have that tax liability that they know they'll pay at a later date. So they are able to offset part of the losses that they make on paper through negative gearing because they know they're going to get discounted capital gains at a later stage. And that's why our recommendations focus on a sort of holistic approach to housing taxation reform that sort of deals with capital gains and negative gearing at the same time, noting that capital gains is probably the most important part of the puzzle because it becomes a lot less attractive to negatively gear if you're not going to make a discounted gain at the end. So in a sense, negative gearing sort of goes back to its pre-1999 original purpose, which is to compensate people that have incurred genuine losses on their investment and not just deferred gains, as is currently the case.
We've heard from the housing industry that any change would, in their view, particularly affect the supply of affordable rental property. So what safeguards do you think would prevent particularly investor participation in a tightening rental market in already constrained regions?
James is a bit of an expert in this area.
So from the research we read, any direct impacts on rental supply and rents would be very minimal, almost non-existent. It's because investors contribute very little to new supply. Only 1 in 8 property investor loans are for the purpose of constructing new dwellings. And for every dwelling removed from rental supply due to tax reform, a tenant can become an owner occupier. So, demand and supply stay in equilibrium. In addition, if there are any minor impacts, which we think are very small, they can be offset by investing just a fraction of the revenue into social housing, which is also a much more reliable way for government to boost supply, and also the right kind of supply that improves affordability, because the aim of this shouldn't just be to boost supply, it should be about affordability and those who can't afford it. The small share of homes that are newly built as a result of investors, when typically sold at market rates or rented out at market rates, are generally largely unaffordable to people on the lowest incomes. Our latest analysis, for example, shows that the median national rent would be $15,000 too high for the median household in the lowest two income quintiles. So for those reasons, we think not only the impacts are minimal, but also they could be easily offset, and the revenue provides a real opportunity actually to shift the affordability conversation, which is not just about supply, it's about curbing demand as well.
And if you go back to property development models, if the price for new housing is more than cost plus profit for property developers, developers will build. I think the reason why many lobbyists in the property development industry sort of make those points is because they're not just property developers, they're also land banking, they also have a lot of residential property, so it will affect their bottom line, and they are quite opposed to reform because of this. We often see this threat of investors exiting the market coming up every time we talk about housing reform, but evidence shows that they do not actually follow through. We heard the same things about rental reforms when we were asking at the state level to have better provisions around evictions, that people were going to exit the market. And then you look at the data around the number of rental bonds that are being lodged, and it's just not correct. So for us, we see that risk as being quite minimal. There is plenty of demand in the market, including frustrated demand from a lot of people who'd like to purchase but are currently not able to. And James has detailed the effects a little bit more, but we see this as a very sort of minimal risk.
Okay, thank you, Chair. Thank you.
All right, thanks, Senator Dowling. A few questions from me. Look, you've alluded to this in some of your responses already, but I just want to explicitly ask both organisations whether if there was a decision by government to either reduce or eliminate the capital gains tax discount, would that change the proportion of the housing stock owned by owner-occupiers as opposed to property investors?
Well, at the end of the day, if somebody moves tenure from being a renter to an owner-occupier, that's a good news story. Like, that's not, if we're ultimately looking for, and we are at National Shelter, always looking for housing security as the gold standard. Housing security for people on low incomes, especially. So every time that a first home purchaser is not having to compete with an otherwise investor, that means the house doesn't disappear, it goes there. So to that end, it's a zero-sum game to that extent.
And to put a number to that, I think at the top of my head I can provide more information on notice, but we expect increases in home ownership between 2 to 5% over the next 10 to 15 years from those reforms. Obviously, modelling is extremely complex and we can't predict the future because reality is complex and chaotic, but yeah.
Is that based on a 25% discount rate?
Reduction, yes.
Yeah.
Just add to that.
Thanks, Mr. Hall.
A 2 to 5% increase in home ownership is really significant in the context of a fall in home ownership rates of sort of 3 to 4% over the last 2 decades, particularly for younger people. So if you look at the age groups 25 to 29, 30 to 34, and 35 to 39, the proportion of those groups owning homes has fallen by 7% over the last 2 decades, whereas the average across age groups is that sort of 3 to 4%. So we think that's really significant. The acuity of the problem is quite evident in the latest December lending indicators. So property investors bought almost twice as many homes as first home buyers in that quarter, and already typically wealthy property investors are being helped by these tax breaks, and so their average loan size is around $100,000 higher than a first home buyer, and that loan size has grown about 10% more than the loan size for first home buyers from 2019 to 2025 on average.
Can I just add something quickly? This is where intergenerational equity comes in. This is where it really matters. Young people, by and large, don't pay that much income tax. If we have a progressive income tax system, young people tend to have lower incomes, and indeed their share of personal income tax paid has fallen by half over the last 30 years. The real impact for young people is housing affordability.
All right, thank you. And just on the ACOS submission, your submission provides an analysis of that indicates that wealth in Australia is actually more unequally distributed than income, and also that wealth inequality in Australia is increasing. And I personally have no argument with either of those assertions. But I want to ask whether, in your view, the capital gains tax discount contributes to those effects.
Well, by definition it must, because a capital gain is an accretion of wealth. And so even if the revenue impacts in a given year are relatively small compared to the overall stock of wealth, if you tax the accretion of wealth consistently at higher rates, then you are reducing wealth inequality by definition. And as we've mentioned before, that applies as much to equities as it does to housing, probably more to equities, because equities are distributed more unequally than rental property. However, the highest 10% of households ranked by wealth, and this is from our research with NSW Sydney, hold around 2/3 of all wealth in the form of either equities or rental property.
Just briefly to add to that, if I may. So in addition to looking at that wealthiest 10% of households that own 2/3 of the value of investment property and shares, if you look at the lowest 60% ranked by wealth, the households, they own just 5% of investment property by value. So this divide is significant. The inequality in wealth has grown significantly also in the last 2 decades. So the wealth of that highest 10% ranked by wealth has grown by 84% over 2003 to 2022. The wealth of the lowest quintile grew only by 20% during that time. And we can see now the proportion of that is largely these assets that attract CGT, like property and shares.
Thank you. Would National Shelter like to add anything to that?
Nothing specific, no.
All good?
No.
All right. Thank you. Again, ACOS, your submission recommends reducing the CGT discount for trusts. Could you just talk us through why, obviously why you think that's desirable, and whether you think trusts use the discount to minimise or, dare I suggest, avoid paying tax?
Thank you. As we've been arguing, it's desirable to tax investments as consistently as possible. So if the discount is reduced for individuals, it should be reduced for trusts and for superannuation funds. The discount for super funds was introduced at around the same time as the discount for individuals, and if it's being reduced, it should be reduced for both. Frankly, I think the Senate should consider a separate inquiry on the tax treatment of trusts. It's hugely interesting and complex, and it gives rise to enormous tax arbitrage opportunities for those who can take advantage of discretionary trusts. As with other tax avoidance strategies, trusts magnify the benefits of concessional taxation of capital gains. So, as previous witnesses have indicated, capital gains and losses can be streamed to the beneficiaries that can take greatest advantage of them from a tax point of view. And there's another wrinkle in the tax treatment of capital gains within discretionary trusts, which I think other submissions have pointed out. Capital gains are not realised for tax purposes when they're attributed to the beneficiary of a discretionary trust. That is not treated as a realisation event, and so tax is thereby avoided or delayed. So tax treatment of trusts should be considered separately, but it does interact with the arbitrage opportunities arising from concessional tax treatment of capital gains. And ditto, the tax treatment of super and superannuation funds are, of course, trusts in their own right. There's an interesting article in the Telegraph online today which talks about how you can best take advantage of tax breaks for capital gains, and one way to do so is to inject your assets into super and claim a huge deduction. And then, of course, in retirement phase, tax rate is 0 on income, and so the capital gain is not taxed, 0 rate of tax. So all of these factors need to be considered.
We specialise in housing policy, so we defer to ACOS on trust, but we would also support an inquiry into the use of discretionary trusts. Just a quick statistics. 95% of the wealth held in discretionary trusts is from the top 20% of wealthiest households. And I think that really says it all, because while there are legitimate reasons for using trusts, such as protecting assets for or from family members that may have limited capacity to manage their financial affairs, when you look at the distribution of the use of trusts, it's pretty clear that they are mainly a vehicle for tax minimization and tax avoidance. And we believe in a fair, just tax system that taxes everyone at their marginal tax rate. We would strongly support that reform of CGT also applies to trust and a broader inquiry.
Just briefly, that top quintile of wealth that has around 95% of assets, their net worth on average is 3.27 million. And we've seen this significant rise in trusts, just the number of them over the last couple decades. Around 80% of them are discretionary rather than fixed. So rather than having a fixed income stream attached to them, it suggests they're overwhelmingly being used for these tax planning purposes.
All right, well, thank you all very much for your submissions and for coming along to give the committee the opportunity to hear from you this morning. If you are intending to provide any further submissions to the committee, if you could ensure that the Secretariat has that by Thursday, the 5th of March, that would be helpful. And once again, the Senate and the committee thank you for your attendance and your engagement with this inquiry. Thank you. I now welcome Mr. Saul Eslake via teleconference. I understand, Mr. Eslake, that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear today?
Thank you, Chair. My name's Saul Eslake. I'm an independent economist and I'm appearing in a personal capacity, not as the representative of any organisation or any other people.
Thanks, Mr. Eslake. I now invite you, if you wish, to make a short opening statement, following which the committee will have some questions for you.
Thank you, Chair. Good morning, Senators, and thank you for the invitation to hear my thoughts on this subject with you. The 50% discount on capital gains that the subject of your inquiry was introduced in 1999 upon the recommendation of the Review of Business Taxation chaired by leading businessman John Ralph. Mr. Ralph argued that the change he proposed would turn Australia into a nation of entrepreneurs and shareholders. It didn't. The proportion of the adult population who owns shares has dropped from 41% in 1998 to 38% as of 2023. And the proportion of the employed workforce who are owner-managers of independent enterprises has fallen from just under 20% in 1999 to 15.3% as of last year. Rather, what the change to the CGT regime resulted in was Australia becoming even more of a nation of property speculators than we already were. The proportion of taxpayers reporting rental property income to the tax office rose from 14.3% in the 1997-98 financial year to a peak in 2013-14, and at 18% in the most recent year for which we have data, 2022-3, it's still well above the level prior to the introduction of the 50% capital gains tax discount. In particular, the change to the CGT regime in 1999 effectively converted negative gearing from a strategy which had been up until then principally about deferring tax until the investment was sold and subject to CGT at the taxpayer's full marginal rate, less the allowance for CPI inflation on the cost base, to one which thereafter became about both deferring and permanently reducing tax by converting wage and salary income taxable in the year at which it was earned at the full marginal rate into capital gains taxable when the investment is sold at half the full marginal rate. Not surprisingly, therefore, the proportion of property investors who were negatively geared rose from 50.3% in 1997-98 to a peak of over 70% in 2007-8, before falling away over the following 14 years as interest rates declined to record lows, which made it much more difficult to be negatively geared. And this in turn had profound consequences for both the federal budget and for housing markets. Revenue foregone as a result of the capital gains discount has risen from $860 million in 2000-2001 to $22 billion in 2025-26, or if you like, from 1.1% of total personal income tax collections to 6.1% of total personal income tax collections over that 25-year interval. And as Treasury itself has indicated, 83% of the benefits from that discount accrue to people in the top 10% of taxpayers ranked by income. From a housing market perspective, the share of housing finance going to investors rose from 26.4% in 1998-99 to 43% in 2000 and before, reached a peak of 44.5% in 2014-15, before falling to a low of 25% during COVID, but has since then recovered to 40% in the first half of 2025-26. Over the 25 years since the change to the CGT regime, the share of housing loans taken out by investors has averaged just under 36%, which is 9.2 percentage points higher than the share in 1998-99. And it's particularly significant in that context that nearly 82% of all housing finance commitments to investors are for the purchase of established housing, that is, housing which already exists. Contrary to the oft-made assertion, purchases of established housing by investors do nothing to increase the net supply of rental housing, because by outbidding prospective owner-occupier purchases, investors who purchase established dwellings are effectively increasing the demand for rental housing by the same amount as they are increasing the gross supply of it. Hence, any reduction in the CGT discount would not have any material impact on the supply of rental housing or on rents if it applies only to investors who purchase established dwellings. It probably is the case that reducing that discount or reverting to the pre-1999 regime would reduce the volume of investment in established housing. But that would be a good thing, because it would in turn reduce an important source of upward pressure on residential property prices, and it would reduce a significant source of competition for aspiring home buyers seeking to purchase established properties. To the extent that it did reduce the number of established properties available for rental, it would reduce the demand for such properties for rental by a similar proportion and thus would have no impact on the level of rents. If the current discount were to be retained for investors who purchase new dwellings, as only about 18% of investors currently do, or were to be reduced by less than the discount for investors purchasing established properties, it's possible that more investment could be directed towards the construction or purchase of new dwellings, and that would be a good thing because it would likely increase the supply of dwellings for rents. Again, contrary to the oft-made assertion, it's unlikely that property investors would seek to recoup the impact on their after-tax incomes of any changes to the CGT regime by raising rents. Renting isn't a cost-plus business. Rents are largely determined by the interaction between the supply of and demand for rental housing, as proxied, for example, by vacancy rates. Landlords don't typically pass on increases or decreases in interest rates to tenants in the form of increases or reductions in rents. There's no reason to think they'd be any more likely to do so with changes to the CGT discount. Indeed, raising rents in order to recoup the impact of less generous tax treatment would seem to defeat the whole purpose of negative gearing, which is to incur losses that can be used to reduce the amount of tax payable on other incomes. None of this is meant to suggest that reducing the CGT discount is any kind of silver bullet that will on its own solve Australia's growing housing affordability problems. It won't. It will still be essential to increase the supply of housing, both for owner-occupiers and renters, through changes to zoning and planning regulations, reductions in taxes and charges on new dwelling construction, sustained increases in housing industry productivity, and higher levels of public and private investment in social and affordable rental housing. But reducing the volume of private investment in established housing, which reducing the CGT discount would do, would certainly help that end. One alternative to simply reducing the CGT discount or reverting to the pre-1999 capital gains tax regime, which I think is worthy of consideration, including by your committee, is the adoption of a dual or schedular system of income taxation, similar to that used in Nordic countries, the Netherlands and Austria. Under those systems, labour income, that is income from wages and salaries, is taxed on a progressive scale, as it is at present in Australia, while income from capital investment, or passive income as it's sometimes called, is taxed under a separate scale, which could be either at a flat rate, as it is in Norway and Iceland, or at progressive rates, as it is in Sweden, Denmark, Finland and Austria, but with no tax-free threshold and with a Chinese wall between labour and capital income. In other words, no offsetting of income or deductible expenses on one side against the other. As Bob Brunig from the ANU Crawford School has argued, a dual income tax system is more efficient, simpler and fairer than the existing regressive tax treatment of savings. And he also notes that among its attractions are that it has already been successfully implemented in other countries and that it's possible to move towards this system in stages. So, Senators, I would encourage you, if you're minded to recommend changes to the CGT discount that was introduced in 1999, that you give some consideration to recommending that over time, Australia actively consider adopting the system of dual or schedular taxation of labour and capital income that I've just referred to here. Thank you for the opportunity to make those comments, and I look forward to your questions.
Well, thanks very much, Mr Eslake. It's Senator Nick McKim here, and I'm just going to lead off with a couple of questions for you. Look, firstly, thanks for that opening statement. It's very clear that, in your view, reining in the CGT discount would have little or no impact on rents. Can I also be clear with you that well, I'll put it as a question. Do you believe that reining in or abolishing the CGT discount, I'll come to your view on that in a minute, but if it was to be reined in or abolished, would that assist in increasing the percentage of Australia's housing stock held by owner-occupiers and correspondingly decreasing the percentage held by investors?
Over time, I think the answer to that is yes. You've heard in the past week the Leader of the Opposition and the Shadow Treasurer both say, and I'm paraphrasing them, but I don't think inaccurately, that if you tax something more, you will get less of it. And I think that's right. That's why, for example, governments tax tobacco and alcohol with a view to reducing consumption of those products. But the point I would make, and here I'm obviously differing from the people I've just cited, is that I think less investment in established housing would be a good thing, not a bad thing, and it would mean that there would be fewer investors competing with prospective owner-occupiers for purchasing established properties. Indeed, it might even prompt, as defenders of the CGT discount assert, some investors to sell their properties, particularly if they're established ones, and changes to the CGT regime are confined to the tax treatment of established properties, it might prompt some to sell them. And you would then ask, who would they sell them to? Not presumably to other investors, because they would be disincentivized by the less generous tax treatment of investment in established properties. So they would only ever be sold to owner-occupiers. And so I think, as a matter of logic, rather than appealing to any particular economic theory, reducing the generosity of the CGT regime to investors in established properties would result in fewer established properties being owned by investors and more of them being owned by owner-occupiers. In other words, it would contribute, I'm not saying by a huge amount, but it would contribute positively to increasing the home ownership rate, or perhaps more accurately, reducing the rate at which home ownership is falling, as it has been since 1966.
Thanks, Mr. Eslake. Do you have a settled view on whether the CGT discount should be reined in, and if so, what arrangements should prevail, either a discount rate or a return to inflation? And as a corollary to that question, could I ask you to reflect on if the government does decide to rein it in some form, what, if any, transitional arrangements ought to be put in place, for example, grandfathering?
Well, to answer the first question, I would say I've been an advocate of reducing the generosity of the CGT regime since the current regime was introduced in 1999. I used to maintain a list of the dumbest tax policy decisions of the last 25 years, and that was pretty close to the top of it. So I think it should be unwound. There are a number of alternatives that could be considered in that context. One would simply be reducing the size of the discount from, say, 50% to 33% or to 25%. Another possibility would be simply reverting to the regime that applied between 1985 and 1999, whereby capital gains were taxed at the full marginal rate, but with an allowance for the impact of CPI inflation on the cost base of the asset concerned. I acknowledge that that did involve more paperwork, especially for properties as distinct from shares. Although even in the case of shares, when, for example, there were rights issues of shares or bonus issues of shares, there would be complicated paperwork entailed. I suspect that's less of a burden now than it would have been back then, simply because of the greater use of information technology and the more widespread use of accountants to prepare tax returns. But yeah, that's still an issue. But the third option, which I suggested in my prepared remarks, would be to institute a Nordic-style scheduler or dual income tax system where capital gains, along with other forms of investment income, including interest and dividends, rent, and income distributed through trusts and partnerships, was taxed on a separate scale, either at a flat rate or at a progressive system, as some countries with scheduler systems do. I don't have strong views as to the superiority of any of those three options. Obviously, the latter one is initially more complicated than either of the first two, but I suppose I would say the longer-term goal that I would most strongly support would be the adoption of a Nordic-type dual or scheduler system. I just acknowledge that that can't be done overnight. It could be phased in, as Bob Brunig, among others, have suggested. As to transitional arrangements, instinctively, I don't like grandfathering changes because that privileges people, in essence, on the basis of when they were born or when they took particular decisions. I don't like that. But if grandfathering were necessary in order to get any changes at all to the CGT regime, then I'm never one to let the perfect be the enemy of the good.
Thanks, Mr. Eslake. I can't resist asking you this question. What, in your view, are the tax policies that are dumber than the capital gains tax discount?
Oh, well, I'd have to go back to one of them that was on that list was the decision to allow people to make contributions of up to, I think, $1 million to their superannuation funds for a temporary period that applied between 2006 and 2008. If memory serves me correctly, though, I don't recall precisely what that was, but I thought that was an incredibly dumb decision. A more recent one, of course, that could be categorised as tax policy is the corruption of the GST revenue sharing arrangements instituted by the Morrison government, that expanded and enlarged by the Albanese government, that is resulting in the federal budget gifting the government of Australia's written state, Western Australia, what will now be around $7 billion a year, so that Western Australia can run budget surpluses while every other government in the country is running deficits. And ultimately so that Western Australians, the richest Australians in the country, will come to enjoy better public services while paying lower taxes than state taxes than other Australians. I stand by the assertion I've made that that's the worst public policy decision of the 21st century so far. If the capital gains tax discount policy had been introduced in 2000 rather than 1999, it might be a competitor for that price.
Interestingly, Mr. Eslake, you currently have a panel made up of 2 Tasmanian senators and 1 from Western Australia. So
You probably shouldn't have a GST.
so perhaps we won't go into that particular piece of your evidence in any further detail. Look, other witnesses have raised the possibility of a dual tax system, as you have. I wanted to ask you whether, if that system were implemented, would that mitigate against the phenomenon of people kind of locking in, so basically holding off on selling their investment properties until they hit retirement when they move down the income tax scale?
That's a possibility. That's also, of course, a possibility under grandfathering arrangements. I recall when Paul Keating introduced the capital gains tax discount in 1985, but grandfathered assets that were held up to that point, there was a discernible locking effect that people held on to assets that they had bought before, I think it was sometime in September 1985, that were exempt from the capital gains tax for extended periods. And that's a distortion. And that's one reason why I think grandfathering is a bad idea in principle. But as I say, if the political reality is that grandfathering is something you have to do in order to get any change at all, then, as I said, I'm not one to want the perfect to be the enemy of the good.
Thanks. I'm going to offer the call to Senator Dowling.
Thank you, Chair. Mr. Eslake, there's a lot of things have been attributed to the capital gains tax discount changes, and you've challenged the claim, I think, from the Ralph Review that it was going to create a nation of entrepreneurs and shareholders. Others have said that the capital gains tax drove this accelerated housing affordability issue. To what extent do we need to be careful about looking at this correlation versus causation issue? I mean, with the extent to entrepreneurs and shareholders that there was broader structural shifts in the economy around declining small business formation, increased institutional investment, do you think those trends changed because or not at all because of the shift in the discount? And a related question, to what extent has the housing affordability issue that we've seen, not just in Australia, since the 2000s, attributable to the capital gains tax discount change?
Well, Senator Dowling, you're right, and as a trained economist like I am, you would recall from your undergraduate lectures that correlation does not imply causation, and I'm not seeking to assert that. There obviously were other things going on that affected the proportion of the population who were shareholders or entrepreneurs. One of those, of course, being the ongoing spread of superannuation and the increasing proportion of people's incomes that were compulsorily contributed to superannuation, and the exposure that that gave most working Australians indirectly to the share market. That was presumably a factor. On the other hand, there were also factors that were working in favour of increased direct ownership of shares, such as privatisations. A lot of people became shareholders in many cases for the first time through the privatisation of Telstra or the demutualisation of the AMP Society and the National Mutual Society, and some privatisations that took place at the state level. So, that was a factor that could have been pushing direct ownership of shares in the opposite direction. In the same way, there were a whole lot of changes that were particularly made during the last two terms of the Howard government that were consciously intended to encourage small businesses, subcontractors and so forth. And they've continued, into the present day where, for example, small businesses pay 5 percentage point less in company tax than larger businesses, or going back to the early 2000s, the entrepreneurs tax offset that was introduced by the Howard government. And so, I think it is instructive that despite the assertions that were made by John Ralph and by proponents of the changes that his report recommended at the time when they were made, none of those things have happened. And I think perhaps one of the factors that might explain the contemporaneous increase in the proportion of Australians who were property investors with a decline in the proportion of Australians who were direct shareholders or entrepreneurs, for want of a better word, is that the change to the capital gains tax regime in 1999 was much more generous, as it turned out, to property investors than to investors in shares, or, as far as one can tell, investors in owner-managed businesses. That wasn't a deliberate intent of the policy, but rather it was the inevitable result of the fact that the faster the rate of inflation of the asset in question, the more generous, compared with the pre-1999 tax regime, the more generous the 50% discount actually is. So that discount was worth far more to property investors than it was to investors in shares. Another factor that probably contributed to that result is that banks have been much more willing to lend a higher proportion of the value of a property investment or a property investment portfolio than they have been willing to lend as a proportion of the value of a share portfolio. And that obviously reflects the judgments banks make about the risks associated with fluctuations in share prices compared with fluctuations in property prices. And of course, banks usually won't lend directly to a small business unless it's secured by property, usually the business owner's own home. So again, the interaction between the tax system and the availability of credit has played a role, I think, in the outcomes that I was describing.
You've also argued that the 1999 change that also converted negative gearing from a deferral strategy effectively into a permanent tax reduction So is your evidence that the issue really is the interaction of the capital gains discount and negative gearing rather than just considering the discount in isolation, which is effectively what this committee is largely limited to?
Well, I think it's both, Senator. In other words, even if negative gearing were not possible under Australian law, the increase in the generosity of the CGT treatment of investments that occurred in 1999 would have encouraged more investment. And particularly in property, because of what I described before as the greater willingness of lenders to lend against a property portfolio than against a share portfolio, and because, as it turned out, property prices rose much faster over the ensuing 25 years than share prices did, and so the CGT discount was more generous. Even if negative gearing hadn't been a long-standing feature of Australia's tax system, which it has been, that change would have had, at least qualitatively, the effect which it has had and which I described. But I think the CGT discount interacted with negative gearing in a way that made it a much more popular strategy, as evidenced by the fact that in the 5 or so years immediately after the change, there was a very material increase in the proportion of property investors who were negatively geared.
Thank you. We heard from the property industry representatives yesterday that anything to reduce incentives to invest in property could actually impede housing affordability or access to affordable rental property. Now, you've argued that investors purchasing dwellings doesn't actually increase the net rental supply, and therefore reducing their activity would not affect rents. So is it your assertion that an investor exit is just simply a one-for-one replacement by an owner-occupier?
When we're talking about established properties,
yes. Okay. And what about the view that in terms of rental affordability of taking away investor activity in the housing market?
Well, again, focusing on established property and reiterating that over 80% of the borrowing by investors is for the purchase of established properties, that is, properties that already exist, that if there were fewer investors purchasing investment properties, yes, that would reduce the gross supply of housing available for rent, but it would reduce the demand for rental property by an almost exactly equivalent amount, and so there should be no net impact on rents. If you were to remove or to make the tax treatment of investment in new properties less generous, then there might be some adverse impact on the overall supply of rental housing, but that's why I'm very much open to changes which would abolish or reduce the discount for investors in established properties whilst retaining at least some form of more generous tax treatment for investors in new properties. That might, I'm not going to say it necessarily would, but it might skew more investment towards the construction or purchase of new dwellings for rent, which I think would be a good thing.
A lot of the evidence has also suggested, depending on your objective, whether it's housing affordability, intergenerational equity, changing the discount and any revenue that was generated, the use of the funds is just as important as changing the tax measure itself. And I think, for example, the Grattan Institute said if you think about intergenerational equity, the benefits would come more by applying the funds to reducing personal income tax than actually changing the CGT discount. Do you have a view about how the funds would need to be used in terms of achieving intergenerational equity, or I think you've also emphasised that just using it for fiscal repair?
Well, yes, I would say that reducing or abolishing the CGT discount and using the resulting increase in revenue to reduce the budget deficit would have the effects on the housing market that I have described. And since it's younger Australians who have been most disadvantaged in terms of accessing home ownership by the very large increase in the presence of investors in the housing market since the early 1990s, but particularly following the change to the CGT regime in 1999, that in isolation would be a contribution to reducing intergenerational inequity. But obviously there are ways in which the revenue from changes to the CGT regime could be used other than reducing the deficit, that could make an even bigger contribution to reducing intergenerational inequity. I would say just simply reducing personal income tax without being more specific about exactly how you would reduce personal income tax and whose personal income tax would be reduced. If you don't say that, don't specify that, then it's not clear what additional impact that would have on intergenerational inequity. There are other things that could be done on the expenditure side of the budget, for example, applying whatever revenue reducing or abolishing the CGT discount generates to increasing the provision of social housing, or providing some financial assistance to the states to induce them, for example, to replace stamp duty with a more broadly based land tax, which I think would help put downward pressure on land prices. That would be another way of improving intergenerational inequity as well. So I think while there's a legitimate argument that doing something other than reducing the deficit with whatever revenue is generated in this way could further enhance intergenerational equity, I think you need to be more specific about what you're actually proposing to do before you can legitimately make that assertion.
Okay. And do you generally concur with some of the other economic literature who have heard that the effect on house prices of the capital gains tax discount, if it was removed entirely, it might be between 1% and 3%. Others have suggested they think it could go a lot further, and they don't think that economic literature is valid?
Well, I haven't done any modelling, so I'm not really in a position to offer my own ideas as to what the percentages would be. I note that advocates or defenders of the existing CGT regime often like to assert that changes to it, tinkering with it, as they often like to say, would result in a mass exodus of landlords from the property market. If that were true, and it might be, that would, I think, put rather more downward pressure on prices than the formal modelling has suggested. And that's my instinct, is that it might be more than 1% to 3%. And in that context, I suppose I'd note that the modelling that was undertaken by Treasury about the impact on house prices of the government's 5% deposit scheme suggested a very small impact, whereas the evidence we've got so far since that scheme came into effect suggests that the impact on prices has been bigger than the formal modelling has suggested. What that implies to me is the possibility that the formal modelling understates the impact that all sorts of changes to the way the housing market operates and the incentives that participants in it face are underestimated by formal modelling.
Thank you for that.
Mr. Eslake, just one final question from me. I just invite you to reflect on Australia's tax arrangements more broadly, and whether you think that it should be a goal for the government or the parliament to tax income generated from labour more closely to income generated from capital?
I would put it the other way round. That is to say that I think in general, and I want to mention one specific exception to this generalisation, that income from wages and salaries is taxed more heavily than income which comes in other forms, mostly from investments, with one particular exception, and that's interest. Interest income is taxed in exactly the same way that income from wages and salaries are, with no allowance for the impact of inflation on the principal on which interest is paid, unlike, for example, capital gains, or unlike the way in which dividends are taxed with dividend imputation, effectively at the company tax rate. And yet interest income makes up a bigger proportion of lower income earners' income, total income, than it does of higher income earners' income. And in particular, I suppose, the failure to allow anything for the impact of inflation on principals has a particular detrimental impact on those people who are saving up a deposit for their first home, because typically those savings are made in the form of interest-bearing deposits. So I think that's an area that has been neglected. From a broader perspective, of course, on-labour income is more likely to be earned by older people and by higher income people. So the difference between the tax treatment of capital income and labour income is a factor in increasing the inequity in the distribution of income and wealth between the rich and the poor, but also, and to a greater extent, I think, between the old and the young. I think the schedular system or dual system that I referred to earlier would probably make a more fundamental contribution to reducing that inequity than tinkering with particular aspects of the existing Australian income tax system, such as changing the CGT regime without, for example, also thinking about the way that interest income is taxed, or income that comes to people through trusts, for example, is taxed.
Mr. Eastlake, thank you very much for taking the time to come along and give evidence to the committee today. On behalf of the Senate and of the committee, we offer you our thanks. The committee now stands adjourned until 1:15. The committee is back in session and will recommence with Dr. Ken Henry. I understand, Dr. Henry, that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear today?
Ken Henry, and I appear in a personal capacity today.
Thank you. I now invite you to make a short opening statement if you wish, following which the committee will have some questions for you.
Sure. Okay. And thank you for the opportunity to be here to discuss what is clearly a rather important policy issue. And I must say it's a policy issue that has occupied my mind for more decades than it should have. I thought that it might be useful to the committee to step back a little and reflect on the reasons for the existence of the capital gains tax, why we ended up with the capital gains tax discount, and why it's now an appropriate time to be considering the future of that particular discount. And committee members would be aware that a little over 50 years ago, the ASPRI Committee of Inquiry into the Australian Taxation System reported, and if I could summarise its findings in a pithy way, I would say that what the committee found was that the Australian income tax system was full of holes, that we had a very, even in those days, an antiquated system for the taxation of goods and services. And it drew attention to three big consequences of those things. Firstly, complexity. The system was just hugely complex. Secondly, it drew attention to the economic inefficiencies caused by having a taxation system that's full of holes and has a narrow base. And then thirdly, it drew attention to the rather serious equity issues associated with a taxation system with those sorts of design elements. It didn't spend a lot of time focusing on intergenerational equity per se, which is obviously a topic that has gained much more currency in recent years, but it certainly drew attention to horizontal and vertical equity issues that people then spent the next several decades talking about in policy circles, and which really shaped policy debate in Australia for quite a considerable period of time. It wasn't until 1985 that the Australian Parliament turned its attention to how best to address some of those issues that had been identified. And when the Parliament did turn its attention to addressing those issues, it was guided by the ASPRI Committee's advice that the direction of reform should consist of two elements. Firstly, broaden the base. Broaden the base of existing taxes, so broaden the base of income tax. Cover in some of the potholes in the income tax system, one of which we're talking about today. And then at the same time, cut the rate. The rate that was in focus in those days was the top personal marginal income tax rate, which in those days was 60%. So the advice was broaden the base and cut the top marginal tax rate. And by broadening the base, the committee had in mind not just broadening the base of the income tax system, but also broadening the base of the indirect or consumption tax system. Few people seem to remember that after the Hawke government legislated through the Parliament the fringe benefits tax and the capital gains tax in the mid-1980s, even after those things had been legislated, they remained politically controversial. And indeed, in the 1987 election campaign, then opposition leader, subsequent Prime Minister John Howard campaigned vigorously against both and undertook that if the coalition were elected to government in the middle of 1987, it would abolish both the fringe benefits tax and the capital gains tax. The coalition had the same position on capital gains tax in the subsequent election in 1990. In 1993, the position was not quite as strident, but nevertheless, the position was to water down considerably the capital gains tax. So too in 1996. What happened, as you know, is that eventually in 1999, the capital gains tax discount for the impact of consumer price inflation, that particular discount was replaced with a flat 50% discount. I make the point because, make that history or recount that history because these issues have always been politically controversial. And you know that, you know how long it took for the goods and services tax, the broad-based consumption tax to be legislated in Australia. That took 25 years from the publication of ASPRI. It wasn't until 1 July 2000 that we got an operational goods and services tax. At the time, that was described by most commentators as producing a tax mix switch. More reliance on consumption taxes, less reliance on income tax, and the argument was that through placing less reliance on personal income tax, young workers, well, workers generally, would be advantaged, and by fixing up the consumption tax system, we would have a growth tax in indirect taxes. As it happens, the proportion of gross domestic product or indirect taxes, total indirect taxes, the proportion of gross domestic product is the same now as it was before the introduction of the GST. There are reasons for that, but it's certainly not a growth tax. And what about income tax rates? Well, the top marginal rate of tax was, as I said earlier, 60% before the Hawke and then Keating government's reforms. By the time they lost office in 1996, the rate was down to 47%, plus Medicare levy, of course. And today, after the so-called tax mix switch, sits at 45%, plus 2% Medicare levy. I would suggest that those who are motivated by the call to broaden the base and lower the rates would find a top marginal rate of tax of that size quite extraordinary, and I do. It does seem to me that after all the work that was done, we should have been able to manage a top marginal rate of tax, to put it colloquially, with a 3 in front of it. And that was certainly what was in the minds of people like me who were engaged in the tax reform exercise back in those days. We should have been able to produce a top marginal rate, including Medicare levy, of less than 40%. Of course, we do have a higher tax threshold at which the top marginal rate cuts in these days. Instead of cutting in at 50,000, it cuts in at 190,000. But if you look at that threshold as a proportion or as a ratio to the average income of a full-time Australian employee, you find that it's still less than 2 times, which on international comparisons for a rate of that height is rather, well, it's a bit of an outlier. It's rather extraordinary. And so I find that the income tax system today still has holes in it, still has a quite progressive personal income tax structure, has an indirect tax system that is eroding by design, by the way. It's eroding by design. Some of it's not by design, but rather as a consequence of negligence, and I'm referring there to fuel tax excise in particular. And one of the outcomes of this tax system that we still have is that it encourages people to do exactly what Commissioner Asprey related back in the 1970s, which is to find all sorts of creative ways of sheltering wage and salary income from tax, particularly from the top marginal tax rate. Which brings us to, or brings me, to rental property investments, because that's what they're about. Rental property investments are primarily, under Australian tax law, a vehicle for sheltering wage and salary income from tax. I might leave my opening remarks there.
All right. Thanks very much, Dr. Henry. You mentioned intergenerational equity, or words to that effect in your opening comments, and you've made other public comments about the need to fix the intergenerational pact. We've heard evidence from people like Bill Kelty, who's described Australia's current tax system as cruel and obscene because of its unfairness towards young people. About 4% of the benefit of the capital gains tax discount goes to people under 35. Now, that's not a surprising figure, given the fact that older people are generally going to have more wealth to invest and time to realise capital gains. But would you accept that the capital gains tax discount is a driver of intergenerational inequity in Australia?
Well, yes, I would. I know that this has been a matter of some public debate for quite some time, and I've seen remarks to the effect from people whose views I certainly do respect, that it may be more of a horizontal equity issue than it is an intergenerational equity issue. I think it's both. I do believe it's both. As you know, wealth in Australia is not as evenly distributed as it was, say, 20 years ago. It's becoming less evenly distributed. And the tax system has, in my mind, certainly played a role in that. And you could say, you could look at any particular age cohort and say, well, the wealth distribution in this age cohort is more unequal than it was 20 years ago. You could go down through the age cohorts and you could make that observation. But here's the thing. The intergenerational inequity, I would suggest, lies in lost or lack of opportunity. When I started work in the Australian Treasury in the mid-1980s working on tax reform, I was also in the market, because I'd just moved back to Australia from overseas, I was in the market for a house. And in those days, mid-1980s, the average or the median house price was 2.5 times average earnings. 2.5 times. Look, it was a struggle. It was a hell of a struggle. Of course, in those days, interest rates were higher than they are today. That is true. But the prospect of laying out 2.5 times average earnings to buy a house was truly terrifying. Today it's 6 times, 5.5 to 6 times. People of my generation, 2.5 times, we squealed like wounded pigs, but we did it because we had the opportunity to do it. I cannot imagine how anybody on the salary I had back in the mid-1980s as a senior Treasury advisor could possibly contemplate buying a house at 6 times average earnings. I just cannot imagine it. And so I think there is a loss of opportunity there that does great injustice to younger generations of Australians. I do.
And you've spoken about the relativities between wages and house prices there. Is it your view that the capital gains tax discount has contributed to, at some scale, to the housing price bubble?
Yeah, sure. Well, I don't know whether it's a bubble or not. I don't know that wasn't important to your question. That's not important to your question. Well, there is an element of bubble psychology in it that is really, really important. And it's this. A negatively geared rental property investment only makes sense if the investor expects to reap capital gains at some point. I mean, otherwise it's just stupid. And I don't believe that people buying into rental property investments are stupid. I don't. I think they're smart people. That's what I think. So, they expect to make a capital gain. And I reckon that when potential investors see house prices start to move, they start asking themselves the question, okay, is this going to be another housing boom? Another opportunity for me to secure significant capital gains? Because if it is, then I'm going to go out, I'm going to borrow because, you know, I've got the asset backing to be able to borrow. Banks think I'm pretty good. I'm not a young person in the workforce in my first job who has no proven track record and no savings behind them. So I can go out and I can get on this train, which appears to be accelerating. And that's what you see. I mean, what you see in the Australian property cycle is that typically, once house prices start to move in the upward direction, more and more of the purchasers at any auction are investors. And fewer are owner-occupiers. And it's no coincidence, therefore, that the proportion of the Australian housing stock owned by owner-occupiers has been falling over time. That's what's driven it, right? Think of it this way, an alternative way to think of it. Every time you stand at an auction, as I did with both my children in Sydney trying to help them buy an owner-occupier house, and failing, every time they failed to an investor, purchaser. The alternative would have been that that property would have been sold to an owner-occupier, right? One of my kids, but there are, you know, there would be tens of thousands, if not hundreds of thousands, if not millions of parents in Australia who could tell the same story. Stories of standing at auctions, seeing their kids, potential owner-occupiers, being outbid by investors. It makes sense. It's going to happen whenever investors' expectations of asset price growth are sufficiently optimistic.
Mm. And those investors have got the knowledge that they've got a great big tax break waiting for them.
Yeah.
That's the thing. Is that fair, Dr. Henry?
Well, it's neither fair nor efficient, because here's the thing. I mean, when in the Treasury, when I was leading tax policy work, which I did for far too long, the way we used to think about tax system design was like this. We would ask ourselves, okay, what would a neutral tax system look like? Neutral. People don't use that word as much these days, but it's a nice and relatively easy way to think about it. So just ignore tax for a moment and ask yourself the question, well, if we're talking about rental housing investment, if there's no taxes, what would a marginal investment look like? one that's right on the margin, where, yeah, okay, this one makes sense. If I pay a bit more for it, it doesn't make sense. If I pay a bit less for it, I'm doing really well. So what does the marginal investment look like? And the marginal investment is pretty simple. It looks like this. Your expected rental income plus your expected capital gain is just sufficient to offset your interest costs plus the other costs of property ownership. It's that simple, right? So, if that's a neutral taxation outcome, if that's the no tax outcome, then a neutral taxation outcome would be one in which after tax the same is true. So once you've subtracted tax from rent, subtracted tax from capital gains, the after-tax amount would just be enough to cover the after-tax costs of mortgage interest plus the other costs of property ownership. And of course in Australia, one of those components, but only one, gets extraordinary treatment. Rental income is included in full. Interest is deductible in full. Other costs of property ownership are deductible in full. But capital gain? Oh no. No, there's something special about capital gain. That cannot be taxable in full. Therefore, you're not going to have a neutral tax outcome. You're going to have a distorted property market. It's the very definition of a distorted market. A market distorted because of the operation of the tax system. And it only happens, and it happens purely because of the capital gains tax discount.
So, Dr Henry, is it your view that the current 50% discount is too generous? And if it is, do you have a view on whether there should be any discount at all? And if so, how it should be applied?
So here's the thing. Think about what I just said about, or reflect on what I just said about a neutral tax structure. What if rent was discounted by 50%? And what if only 50% of mortgage interest was deductible? And what if only 50% of the other costs of property ownership were deductible? And capital gains remains 50% assessable. That's also a neutral tax system. What if rental income was not assessed at all? Zero. And what if interest expenses were denied completely? And what if other property expenses were denied completely? And what if we then said, okay, we're going to remove the capital gains tax on rental property? That would also be neutral, or at least in the case where the property is 100% geared. That is, it's all borrowed. That would also be a neutral tax outcome, right? By the way, that's an option available to anybody who says that rental housing is already overtaxed. Just say to them, well, why don't you propose removing rental housing from the tax system? What would that do to the Commonwealth's budget? You probably know the answer to this. Commonwealth's budget would improve. Would improve. Because rental housing as a whole is a loss maker for the tax system. It's a loss maker, right? So that would improve it. What we said in the tax review that was published in 2010 is, why don't we have a 40% discount? Look, we could have said 30, we could have said 25. There's no, given what I've just said to you about the requirements of neutrality, there's no particular magic here, right? But we said, okay, let's reduce the capital gains tax discount from 50% to 40%. But let's at the same time say only 60% of rental income is included in assessable income. Only 60% of your interest expense is deductible. Only 60% of the other costs of property ownership are deductible. That is, let's have a flat 40% discount rate. That would be a neutral taxation treatment. It reduces the capital gains tax discount from 50% to 40%. Sure it does. But at the same time, it reduces the size of the interest expenses that an investor can claim against, to use to shield their wage and or salary income from taxation. 40%. I've seen other numbers used in public debate. I don't have a firm view. I think the most important thing is to aim for neutrality as best as you can, bearing in mind that there are, of course, practical issues involved, maybe transitional issues, maybe issues of investor psychology, maybe, involved in big changes to the tax system. But that's a second order issue.
All right, well, in your pursuit of neutrality, in the absence of any change in the treatment of some of those things you mentioned, rental, interest and so forth, would the pursuit of neutrality be best served if you just had the lever of the capital gains tax discount by removing it entirely?
Yeah.
Yep.
Absolutely. Yeah.
Yep. Thanks. You mentioned transitional arrangements. Do you have a view on things like grandfathering?
I hate it.
You hate it? Don't worry about
and not just because it's a sexist term these days.
All right, well,
apparently.
Grandparenting, Dr. Henry. Let's settle on that one. I'm happy with that.
No, look, I understand it. And if I were in your position as senators, it's something I would give a lot of attention to. I would think very deeply about it. I get it. But everywhere I've seen it done, and I've seen it done in too many places, everywhere I've seen it done, it's caused all sorts of what used to be referred to as unintended consequences. I don't know if we have those anymore, but anyway, that's what we used to call them, terrible distortions that put you on a bit of a slippery slope when it comes to policy making.
Dr. Henry, you've obviously been involved in a lot of policy development in your time. I've been minister, albeit in a state government, so I've had some experience in that sort of interrelationship between secretaries of departments and who are policy experts and ministers who, fair to say, have at least one eye on the politics of the situation. The Treasurer, Dr. Chalmers, has said that he's listening closely to this inquiry. If you were Treasury Secretary now and you were aware that the Parliament was such that Labor has a stonking majority in the lower house and Labor plus the Greens is the numbers in the Senate to get through a package of ambitious progressive tax reform, what would you be saying to your minister?
Well, the first thing I would say is, can we have a conversation about the tax review that was published in 2010? There's a lot of good ideas in there that I think it would be timely to action. But the second thing I would say is, yes, it is time to do something in this space. Absolutely, it's time to do. Maybe he was listening very closely.
He may be listening more closely than we thought.
Jesus. All right.
No.
That was Jim.
I wonder if that was Jim. Well, Dr. Henry, certainly that's...
No, look, I would... I would encourage him to... I think there is... look, I'm not the political analyst, but obviously I've been a keen observer of politics for a long time, and I think there's an opportunity. And I do think that younger people in particular would be very, very appreciative of any assistance that the Parliament can give to them in securing a foothold in the Australian property market.
Thank you. Senator Dowling.
Thank you. Thanks very much for your evidence today. I've just got a couple of relatively brief questions. The first is to your point in response to some of Senator McKinn's questions at the end there. You said the grandfathering would be a slippery slope, and I think in some of your public commentary you've talked about grandfathering or grandparenting, existing arrangements would come with problems. I just wonder if you could be a little bit more specific with us about what those problems are.
Yeah, well, maybe if we go to another area of tax policy, superannuation. Superannuation entered the Australian taxation system, that is, taxation started to apply in the mid-1980s. It was in a very small way. But then by the late 1980s, superannuation had been fully incorporated into the income tax system, but with its own special taxation arrangements, but nevertheless it was there. Because of the way that, and then there were changes to policy and changes and further refinements of policy, and at every step along the way, the taxation arrangements were grandfathered. So we had pre-1983 contributions and post-1983 taxed differently. There were pre and post 1988 contributions. There was a whole swag of these things. And what it meant was that by the early 2000s, somebody retiring and wanting to draw their money out of a superannuation fund would find, or would be told by a tax advisor, that depending upon when the contributions went into the superannuation fund, there were 9 different taxation treatments applying. Mm-hmm. Now, we looked at, and we got some evidence, it's in the Treasury, got some evidence on how much the average person retiring was withdrawing from their superannuation fund. It was less than $50,000 in those days. This is in the early days of the compulsory superannuation guarantee arrangements. And then we got some evidence on how much was the average retiree paying in advice, just tax advice, and the figure was $8,000. That's what happened. And so we, the Australian Treasury, recommended to the government at the time to abolish end benefits taxation for people aged more than 60. That's where that came from. That's where it came from. Because through grandfathering, we had created such a policy mess that what it was doing to retirees was unconscionable. That was our view. So, you know, you can grandfather things thinking that you're doing people a favour, but the tax system itself is a pretty complicated animal. And the more grandfathering you put into it, the greater complexity you put into it, the more need there is for people to rely upon professional advice, the more burdensome the Australian taxation system becomes for them, right? So that's an example, but there are many others. I mean, even the capital gains tax itself, as you know, it only applies, well, it applies to any property acquired after the 19th September 1985. They're still grandfathered. I can use the word grandfathered with respect to them because that was in the law. There are still grandfathered properties out there, you know.
Probably largely owned by grandfathers too, I would assume. Look, you're talking about complexity probably leads quite, we can kind of stay on that theme for my next question, which is, in some of your public commentary, you've talked about a 25% deduction.
Have I?
Yes. I think in here, I've got the quote here. It says, a Scandinavian model where you have a unified tax treatment of capital income, all capital income subject to a flat 25% tax rate.
Yes.
Yeah.
Okay, yeah.
So, you know, we've heard, of course, different views over the last few days about how you might reconsider a discount or whether to apply a discount at all.
Right.
And you know, I presume that one of the reasons why you might suggest a kind of a flat discount rate is for simplicity.
Correct.
In your view, why is that? Why would that be a better option than some other kind of, say, indexation
Oh, no,
arrangement
there
or
are two issues here, sorry.
Okay.
So firstly, I do recall the 25%. The 25% is not a discount, so I must have
Okay.
confused somebody, probably myself, in that piece that you have referred to. The Scandinavian model would be to apply a 25% flat tax rate. The capital income.
Oh, okay, sure.
To put all of your capital income and capital expense
Sure.
into a bucket
Yep,
and say everything in that bucket gets a 25% tax rate,
sure.
right?
Okay.
So you...
Not a discount
No,
on the...
you divorce it.
Okay,
It's a
yep.
completely different way of approaching this. It also has a lot of attractions. What it does is it puts a wall between labour income, which is still subject to the normal taxation arrangements,
Yep.
progressive personal income tax scale, and capital income, so that one does not pollute the other, so that you cannot use capital income expenses
to offset you.
to shield your labour income from tax. And that's for both efficiency reasons and also for equity reasons. The efficiency argument is that, and not every tax expert agrees with this, and there's reason to disagree, but there is a lot of literature that suggests that there's a case for applying a lower rate of tax to capital income than there is to normal labour income. There's an argument for that. But if you're going to apply a lower rate of tax to capital income, you've also got to apply, or you should apply, a lower rate of tax to the capital income deductions. Just quarantine them, make sure they're all taxed in the same way. The thing about, the alternative that you mentioned is indexation of the asset tax base. If we were in a tax system that indexed everything for inflation, obviously it makes sense to index the capital gains tax base for inflation. In 1985, when we were designing the capital gains tax in the Treasury, we had quite some energetic debates about this, whether it made sense to index the capital gains tax base when we were not indexing anything else for inflation, not indexing personal income tax rate scales, not applying the same discount to interest costs, right? Because, there's a difference between a nominal interest cost and a real interest cost. As everybody knows, you go out and you get a mortgage, and that mortgage falls in value in real terms over time. Even if you don't repay anything, it falls in real terms over time, and that's obviously a benefit to you, as much as a capital gain is a benefit to you, but which arises purely because of inflation. It's got nothing to do with the asset itself. And so, we had these arguments in the mid-1980s. Why would you index the capital gains tax base when you're not subtracting inflation from nominal interest deductions, and you're not applying indexation to the personal income tax system more broadly? The reason that indexation was applied to capital gains tax and nothing else in those early days, September 1985, was to help with its saleability.
Okay. I guess
It was a new tax.
one of the things that, again, we've heard varying views about this over the last few days is, whether in an attempt to resolve some of the challenges we're seeing in housing at the moment, whether we consider particular changes just to, capital gains tax as it relates to selling a property, because that, some people think might assist free up housing stock and increase rates of home ownership,
Sure.
etc. I'm just interested in your views in that as an argument to consider a change like this, as opposed to something that considers capital income more broadly.
Yeah. No. Yeah, I get where you're going. Yeah. I would like to see the Treasurer do the whole thing. That's what I would like to see.
Mm-hmm.
I would like to see a complete overhaul of the taxation arrangements applying to capital income in all forms: interest, rent, dividends, capital gains, trust distributions.
Okay.
That's what I'd like to see. And there's international experience on what works here and what doesn't work, and the Scandinavian countries in particular have quite a lot of experience to offer. I reckon that's a path well worth taking. Yep. If that path's not taken, then dealing with the most spectacular intergenerational inequity in the tax system, which in my mind, well, actually, there's two, they go together, is this one we've been talking about, which has denied over a long period of time, increasingly denied young workers the opportunity to secure a house for themselves, and then the other is bracket creep or fiscal drag, which, as you know, is the only tax base in the Australian. It's the only base in the Australian tax system that's growing as a proportion of GDP, and so young people. They can see what's going on here. The budget's in deficit, debt is accumulating. They know that some future generation is going to have to pay it, and the only tax base that's growing to be able to pay down debt, well, firstly to get the budget into surplus at some stage, and then to pay down debt, is workers. That's the only one, right? So that too, those are the two principal sources of intergenerational injustice in my view. But yeah, to quickly go back to your question, yes, I would take the opportunity to do something more broad on capital income taxation. If that opportunity is not available for whatever reason, I would do something with respect to capital gains tax applying to, well, capital gains tax generally, right? And I would also have a look at what's happening to the personal income tax system, the rate scale, because I just think that's unconscionable.
Thank you. Senator Dowling, I think, has some questions.
Thanks, Dr. Henry. Just to take you back again to the pre-99 era, and there was a view, I think, coming out of the Ralph review that changing the discount method to 50% might encourage a nation of entrepreneurs and shareholders. Then I've seen another view that it was about introducing simplicity to the system. What was your memory of that, of what the sort of motivation, justification for it, and was the system actually that difficult to administer when it was in the indexation method?
Yeah, right. Memories on this differ. It's funny. You talk to people about it; they have different memories of. They have different memories. The indexation arrangements were not difficult to administer. After all, the Australian Bureau of Statistics publishes the Consumer Price Index that provides all the numbers you need. I mean, all you needed under indexation for capital gains tax purposes was the original purchase cost. Any subsequent additions, alterations that added value to it, you needed those, and then you just apply the Consumer Price Index going forward to the time of sale. That's not complicated. I don't think that was the real reason. There were, look, I do remember people saying that that applying a high rate of tax to capital gains, like, you know, a 47% rate of tax to capital gains made in a business venture, for example, a startup, might discourage innovation. And I agree. Of course it might. There are two alternatives, though, that are much more sensible than putting a discount through the capital gains tax system. The first is to cut the top marginal rate, so that they're not facing a 47% tax rate, but something closer to 30. That's the most obvious thing to do. And then the second thing to do is to look at the taxation arrangements for those sorts of investments. Now, even back then, and in fact the Ralph Review itself considered some of these options, even back then, tax experts were recommending that government consider cash flow taxation for those sorts of investments. And there's an opportunity to do that again. If we want to encourage innovation in Australia, and everybody seems to think we do, then the government might want to consider establishing vehicles that provide cash flow taxation for those investments pursuing innovation. The dumbest way to do it is what we did. And the reason it's dumb is because it doesn't just provide, that is 50% capital gains tax discount, doesn't just provide a tax benefit to those who are engaged in entrepreneurial, innovative activity that creates jobs and, you know, secures businesses from offshore to locate in Australia. It provides as much benefit to purely speculative investments in assets that generate nothing. Well, nothing special by being in the hands of the investor, rather than, say, an owner-occupier. That's why the 50% discount is on capital gains is the dumbest of all options to pursue that laudable policy objective.
Okay. And we've heard a lot about E61, for example, this morning talked about this strategic timing issue that they think people delay when they're going to realise a capital gain, which may be suboptimal in a broader economic efficiency sense. How should we think, when we think about the capital gains tax discount, to what extent can that speak to issues like capital mobility, productivity, economic dynamism? Is that a relevant consideration?
Yeah, I do think it's a relevant consideration. Yeah, well, I mean, one of the things that, well, look, if maybe I should pause there, because I think there are features of assets that generate capital gains that kind of, even if you don't have taxes, even if they're outside of the tax system, are going to give rise to behaviour that might appear a little bit weird. Like, for example, you know, people don't like realising losses if they don't have to. You know, that's even though that might be the smart thing to do, right? Is to just take the loss and walk, and they don't want to do it, right? And so, and that would be true, I think, in the housing market, even if you didn't have any taxation of housing at all, or if you had 100% taxation of capital gains. I think the argument is stronger when you're talking about transaction taxes, like stamp duty in particular, where the huge lump sums that people have to come up with just to associated with selling one house and then buying another, they're just so large that they do become a disincentive. I don't know what you could do. I do know what you could do to avoid that consequence, that being a factor in people's thinking about capital gains tax. But my sense is that the Australian Parliament has no appetite for it, which is, tax the capital gains on an accruals basis. And we have some recent memory of attempts to do that, right? That avoids the sort of issue you're talking about. But we thought about that in the mid-1980s as well. Some wiser heads knocked some sense into us when we were designing the capital gains tax.
And I guess that also might touch on this issue. We've heard that while we see that the benefits of the capital gains tax discount largely accrue to the wealthiest cohort and highest income cohort, it potentially overstates it in some cases because some people may be on very average incomes, particularly at the time they're accruing the capital gain, and then they do that one-off transaction that puts them up into a high tax category, but it's not reflective of their.
That may be the case, but remember, if we're talking about negatively geared rental housing, the big tax benefit, there's two sources of tax benefit, right? Because if the capital gain if there's no capital gains tax, the tax benefit's clear. The tax benefit is purely, if there's no capital gain. No, that doesn't make sense as an investment. Let me just say, there are two components of the tax benefit. The first is the preferred treatment of capital gains, but the second is that the interest expense, which is paid in order to secure the capital gain, that interest expense is fully deductible against other income. And that tax shield is obviously more valuable to somebody on the top marginal rate than it is to somebody on a lower marginal rate. And obviously somebody who's below the tax-free threshold, if they could possibly afford to buy a rental house, will get no tax benefit at all. So the size of the tax benefit increases with the marginal tax rate.
Yeah. Thank you.
All right, thanks. Just a couple of final ones from me. Dr. Henry, firstly, Bernie Fraser told us, he said we should abolish the capital gains tax discount in its entirety, but he also told us that we don't need to adjust the capital gains tax for inflation. Do you have a view on whether we should adjust for inflation or not?
Right. Well, as I said earlier, it was a standout. When we did have inflation indexation, it was a standout in the Australian taxation system. I don't have a problem with tax indexation, but I would say if we're going to go back to indexing the capital gains tax base, I would want to see us think about real as opposed to nominal taxation in other components of the taxation system as well, including interest deductibility. And also, of course, in the personal income tax system generally, reflecting on the personal income tax thresholds. So that would be my view. It was seen, at the time it was seen as a concessional arrangement, right? Defensible in tax policy principles, but nevertheless a concessional arrangement, as was the grandfathering of the capital gains tax, that was seen as concessional, as was taxing capital gains on realisations and not on accruals, right? So there were those three big concessions that were written into the capital gains tax legislation from day one. But we did not take that thinking to other elements of the tax system. And so I would think that if you want to go back to that model, you might want to think a bit more deeply about the other elements of the taxation system that should be put on a real rather than nominal basis.
Yeah, thanks. And finally, I mean, you've spoken a lot today about a more holistic reform of our tax arrangements. Your review from 10, 15 years ago.
16.
16 years ago.
Who's counting?
2010, addressed the need for a more holistic reform. You've also spoken about intergenerational inequity, and it's obviously a motivating factor for you to try and address that intergenerational inequity. Would you accept the proposition that going to work 5 days a week in Australia today is probably the worst way to try and...
It's probably
ahead?
what?
The worst way. Going to work 5 days a week is probably the worst way to try and get ahead in Australia at the moment, as opposed to having enough money to buy something, whether it be a share or a property, and wait until there's a capital gain and then realise that capital gain. And is that, given the fact that younger people are more likely to be going to work every day to earn a living, we've got the wage house price differential that you spoke about earlier, and older people logically are far more likely to be able to have savings or borrow to invest into purchasing something and wait till there's a capital gain when they sell it. Would you accept the proposition that the whole system is just completely and shockingly biased against workers and against young people?
Yes. Yes, I would. I would still encourage them to go to work every day, though. They don't have an option. But we've got to find ways of restoring to this generation of young workers the opportunities that were available to previous generations of young workers. That's got to be the policy challenge, right? This really is, this debate and others that we need to have in this country, policy debates, are really about doing justice to young workers more than anything else.
Dr. Henry, thank you very much on behalf of the committee and on behalf of the Senate for coming in and sharing your expertise and experience with us today. We do very much appreciate it.
It's a pleasure. Thank you for your interest.
I now welcome Mr. Jeff Wilson. Good afternoon, Mr. Wilson. Thanks so much for coming in today. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please state your full name and the capacity in which you appear today?
Jeffrey James Wilson, and capacity, or...
You can be here in your personal capacity, Mr. Wilson.
Okay, personal capacity, thank you. Well, after listening to Dr. Henry, I feel as though maybe I should leave.
The committee would appreciate you staying, and we're very interested in the evidence that you have to provide us today. Senator Dowling has indicated he has some questions for you, so I'm going to ask him to...
Do you want me to...
I'm so sorry,
I've got a little...
Mr. Wilson?
Tell us about... Oh, yeah, okay, great.
Please make
Thank
an
you.
opening statement. Thank you.
Yeah. Chair and members, thank you for the opportunity to appear today. My comments are guided by three principles: improving productivity, maintaining policy stability, and sound tax design. Australia has experienced a prolonged period of weak productivity growth. Sustained improvements in living standards depends on strong business investments, capital deepening, and improved productivity. Tax settings obviously influence after-tax returns and therefore affect these capital flows. The current capital gains tax framework applies a uniform discount across asset classes. It doesn't distinguish between investments that expand productive capacity and investments that benefit from just the asset price appreciation. Investment in operating business supports employment, innovation and economic output. Investment in existing residential property does nothing to increase the economic the economy's productive capacity. Over time, this has contributed to a concentration of capital in existing housing, while business investments outside the resource sector has remained relatively subdued. Housing affordability is also linked to productivity. Over the long term, affordability depends on housing supply, on household incomes, and the economy's capacity to build. Stronger productivity supports higher real wages and increases the resources and investments available for new housing. Improving the allocation of capital towards productive investment, therefore, supports housing affordability through both real income growth and stronger supply capacity. It is also important to recognise the original purpose of the capital gains tax discount. The discount was introduced to replace indexation as a practical way to avoiding taxing inflation rather than real economic gains. Any reform should preserve that principle and should not treat the removal of the discount as a tax grab. The framework that I've proposed in this document is consistent with that approach. Now, first, all existing assets would be fully grandfathered. There would be no retrospective changes and no impact on investment decisions already made under the current rules. Policy stability and investor confidence obviously are essential. Secondly, for future investments, the structure of the discount would be rebalanced. The effective concession for new purchases of existing residential property would be moderated or reduced. The current treatment for new housing that adds obviously supply would be maintained. At the same time, the effective concession for long-term equity investments in Australian operating businesses would be increased, reflecting the longer investment horizon, the higher risk and the broader economic contribution of that capital. Thirdly, the framework is designed to be revenue neutral. Residential investment properties represent the largest share of capital gains. Moderating concessions in this segment provides the fiscal capacity to strengthen the incentives for productive business investment without increasing the overall tax burden. This is not about raising more tax or penalising property investment. Owner-occupiers are not affected, existing investors are protected, and housing supply incentives are maintained. Australia does not face a shortage of capital. The challenge is ensuring that capital is directed towards the most productive uses. This proposal does not raise additional tax or change the rules for existing investors. It improves the incentives for future investment so that more capital flows into productive businesses productive business and new housing. Now, stronger productivity, higher wages, greater housing capacity all come from better capital allocation. So thank you for allowing me to be here today. And as my background, I'm an equity market analyst, so I never worked in Treasury, and I'm not an economist, even though I did first-year economics. So please bear with that after I just heard Dr. Henry's impressive presentation.
We will bear that in mind. Mr Wilson, before Senator Dowling commences questioning, the document you've just provided, can I confirm that you'd be comfortable to have that document tabled?
Yes, yes.
Which would mean that it would become a public document.
Thank you. Yes.
All right, thanks. We'll accept that as tabled.
Yes.
Senator Dowling.
Thanks, Mr Wilson, and thanks for the discussion paper. And don't worry, we've been disparaging economists all through this inquiry, so even though I am one. So just to confirm that your proposal is to reduce the discount on existing residential investment to around 25% or thereabouts?
Well, that was sort of it was to reduce it. To me, I was talking in broad.
Yeah. Okay.
Yeah, effectively, rather than give the benefit to just price appreciation, use that capital to solve one of the big problems we've got in terms of productivity.
Okay. No, I accept that revenue neutral framework you're working in.
Yeah.
But I think probably the most novel part of your proposal is to actually increase the discount in a particular category, which is effectively increasing the discount by 50% to 75% for Australian operating businesses.
Yes, and
how
this
do you
is
define Australian operating?
Yeah, well, exactly. It's got to be defined. This is not listed companies on the ASX. It's really to encourage capital to be available. Well, as everyone talks about, looking for capital deepening, and it would be unlisted. We've already got the discount for the small companies, so it would be Australian operating businesses. There would have to be. There's got to be more work in terms of what the exact definition.
No, I'm just interested because we've heard from like over 80 other witnesses and submissions, and yours is the only one that's proposing to actually increase the discount for a particular asset class. So really keen to understand what that asset class actually is. Yeah.
Well, in theory, it's the asset class is going to significantly increase the productivity in Australia, and that's effectively small and medium sized Australian businesses. Okay. And to be seen to be, to me, to be encouraging investment in those areas. And then in terms of when do you give them the discount, like it's not a, I would envisage it would be, you'd have to have been invested in that business I mentioned. I think in there, I talk about 5 years. Yep. For a period of time. So it's not just someone putting the money in, and then taking it out over a short period of time. It's long-term, high-quality capital.
Yeah. So maybe just take us through a notional sort of case study. So say there's a family, mum and dad, and they've sort of built a pool of savings. They could buy an investment property. They could buy a share portfolio. They could buy one of your listed investment companies. Yeah. They've got it, and there's this. But now you're saying there's another thing that they could consider that might attract a different discount.
Well, in theory, they might want to be entrepreneurial and start their own company.
Oh, okay.
That was the logic.
So it's more for investors. You're thinking, okay, so it's more about that category of person that's thinking about potentially, against all the other ways they could use that capital, putting it towards their own entrepreneurial activity.
Or someone else's, and I remember in, I don't know when exactly it was, but in the Howard period, they came up with a structure called pooled development funds. And that was, and they actually paid no capital gains tax. And they still exist today. And so any gains if you invest in one of those pooled development funds, any profit that's made is tax-free, 100% of it. And that was to encourage, you couldn't invest in property and you couldn't invest in retail in that structure, but it was to invest small company capital formation.
Okay. I'm not sure if you. I asked Dr. Henry this question about around 1999, and you, given the proposal you're putting forward and the objective that, in the Ralph review, he argued that the change to reintroducing a 50% discount that we have today, that would create a nation of entrepreneurs and shareholders. The evidence says that it probably didn't.
Well, I think we ended up with shareholders.
Yeah.
I know. I'm not sure what I don't know if it's 7 million or. Yeah.
Well, we heard from Mr. Eslake this morning, the proportion of adult population who owns shares actually dropped. So it went from 41% in 1998 to 38% in 2023.
Yeah, but still, I mean, on a global basis, 38%, you'd be. I think you'll find that stacks up.
Oh no, I'm not saying it's not high, but it didn't go up because of a change in discount.
Yes. Yeah. Okay. Okay. So you're saying that his theory...
We didn't become a nation of shareholders because of the capital gains tax discount.
Well, we probably became a nation of shareholders because of superannuation.
That's So, I guess therefore, why would we be confident that your proposal would create a nation of entrepreneurship or potentially?
Yes.
That's what I'm getting at.
Yeah.
And how would we avoid, how would the ATO go about defining what's an operating business, and how would we avoid sort of a whole raft of the tax restructuring industry getting excited by this proposal and actually restructuring activities to actually try to gain the discount?
Well, in theory, in theory, there'd have to be, there would have to be some definition of an operating business. I can take that on notice and come back to you.
No, except you've put it in discussion paper. It's not. I'm not going to hold you to every.
No.
What's your rationale for entirely grandfathering the existing framework?
Well, it's just, to me, it's, I remember 1985. Obviously, when capital gains was grandfathered then, and the negative consequence, I think from that, there wasn't a significant negative consequence. To me, I think it comes down to trust. Effectively, people have invested a certain way when, because they currently believe the operating rules are sort of set in a certain way. And I know it's, probably shouldn't bring it up, but I remember, a number of months ago when, we were quite strong on not taxing unrealised gains. And I remember a lot of young people, and this is what surprised me, who had been sort of committed to superannuation. I think it was a 29-year-old. He rang me. His parents were immigrants. He didn't trust property. He started a self-managed super fund when he was 25. I think he put the maximum he could in that, and then he said, "Hey, look, they've changed the rules on me. I'm going to, that's sort of it for me. I didn't trust property from hereditary for living overseas, and I'm not sure why. And then if you keep changing the tax rules, and the people that have sort of done the right thing, and whether it's I heard, Chair, I was listening to a bit of your questions yesterday, and the worker, say if the carpenter who's building the house or the plumber, say he knows that, hey, look, I've got to earn as much as I can. I've got to get some of that capital to work, whether I buy shares or whether I buy an investment property. I need to do that to get ahead. And then he's done all the hard yards, and then you go say, oh well, look, I'm changing the rules on him. See, to me, that's the logic to me of sort of having trust in the system, that there's not a new government, come in and change everything. And I agree that it'd be great, that there's a great opportunity for real tax reform in Australia that benefits everyone. And I agree. Some of the questions and comments earlier, you think about it, if we don't get, and to me the big thing is trying to drive productivity growth. Because if you have productivity growth, then you can have real wage growth. And then if you have real wage growth, then you don't have a situation where the 21-year-old or 22-year-old that gets their first job, that every year, that when property goes up sort of 8 to 10% per annum, and their wage goes up 3% per annum, then they're 7% worse off in terms of their ability to buy the house. And that's a multiplying effect. So, to me, there's enormous opportunity for you guys to create real change.
But you think that taxation arrangements for capital gains is a way to target productivity in this country, though? Because we heard from Dr. Henry earlier that neutrality is what he thinks is a good principle.
Yes.
But you're sort of diverging and saying actually skew the neutrality.
That's, to me, I own one operating business, which won't benefit from this because I'm in the old, I was a shareholder in the old system. But to me is, we need capital deepening, we need capital going to the places that will improve productivity, and as this this was up for debate, I just thought it made sense to put another thought on the table.
Okay, thank you. Thanks, Chair.
Thanks, Senator Dowling. Mr Wilson, can I just try and characterise the broad thrust of your submission, and I'll obviously give you an opportunity to let me know if you think I've got it wrong. I think part of what you're saying is that the existing capital gains tax discount is funneling capital in part into existing housing stock, and you regard that as an unproductive destination for capital. Would that be fair?
Correct. Yes. Yep.
Yep. So, and just to be clear, I'm talking about the existing housing stock here,
yes.
not the small amount of the capital gains discount that that eventually flows into new housing stock. Australia's kind of stuck on productivity at the moment. We're in a slump. I suggest is a fair interpretation of our current productivity. Do you think that if we did rein in the CGT discount to some degree, would that redirect some of the country's capital out of those that unproductive dead end of the existing housing stock and allow it to be invested in more productive parts of the economy?
Assuming there was no change. Okay, you're saying effectively reduce one.
If we just simply reined in the capital gains tax discount somewhat.
Yes.
Or removed it, but anyway, in any event, reduced the discount.
Yeah. All
other things being equal, would that result in a bigger flow of the country's capital into more productive parts of the economy?
I actually think it would.
Yep.
Yes.
Yep.
Whether it goes to sort of and this is sort of, I'm hoping that can be funneled into, the small and medium-sized Australian companies, to get the maximum sort of leverage, rather than it would, assuming. Anyway, sorry.
Yeah. No, that's okay. So I guess it follows then. I mean, you may not be an economist, as you indicated earlier, but you do have a lot of experience in asset management, yes. Obviously. Do you think the capital gains tax discount, the 50% capital gains tax discount, made property investment or property speculation so attractive that it detracted from investment of capital into other parts of the economy, for example, small to medium businesses?
It's a good question.
I'm not trying to trick anyone here.
No, I know you're not. You're being very kind. Thank you. Well, there's no doubt that the capital looks for the best after-tax return. So if that's the case, then that has to be the conclusion, doesn't it?
Yep. Thanks. So we've got a scenario where, I mean, we've had a lot of evidence over the last 3 days. We've received a lot of submissions, and we're very grateful to everyone who's engaged with the inquiry. I think it's fair to say that pretty much everyone except the housing industry accepts that all this money sloshing around in getting invested into existing residential properties is unproductive, and you've agreed with that proposition. Would you think there's a similarity there between some established blue chip stocks in Australia, for example, the big banks, who, in my view, are just collecting economic rent from rising land prices? I mean,
hey, let me take that one on notice.
You can take it on notice, but I guess I'm asking, like, if you compare that with investments into companies like small to medium companies who are genuinely adding to Australia's national productivity.
To me, the tough thing is it's such a big. the question you asked is such a big question. You look at the top 20 companies in Australia because of all the money, and I know because of your the new legislation that sort of forces fund managers to go more to indexing, so they don't get on the blacklist, and also the weight of money to passive has actually pushed. I think it's the top 20 as a percentage of the market. They've gone from. I'll come back with the numbers. I'll take that on notice and I'll provide the numbers for you. And the top 50 companies, it's just there's been a disproportionate amount of money that's gone there, and hasn't gone to these smaller listed Australian companies, and that's all a function of what's it called, the legislation that came in that if you're a super fund and you underperform, you get a black mark on
performance test. Are you referring to the performance test?
Yeah. What's the legislation?
I'm happy for you to come back on that.
Yeah. Okay.
Mr. Wilson.
Okay.
So thank you. I appreciate it. Okay. Look, Senator Bragg has joined us by teleconference, and he's just indicated to me that he does have a couple of questions he'd like to ask you. So I'll go to him shortly. But I just wanted to ask, finally, and this is a sort of a slightly broader question, I guess, but the OECD has recommended allowing a more generous carry forward of losses to encourage higher risk appetite for investments into productive parts of the economy. Do you have a view on the desirability?
Let me take that on notice. I just have to think through, because in theory it's what I say, but then it's the other consequences, isn't it? Yeah.
All right. Senator Bragg's saying to me that he does have some questions, but I don't think he's quite joined us yet, Mr. Wilson. So if you bear with me, I'm going to just... Oh, he has joined us?
Yeah.
Yep.
Can you hear me, Senator Bragg?
Yep.
Okay. We've got Mr. Jeff Wilson AO with us, and you have the call.
Thanks, Chair. Well, Mr. Wilson, I just wanted to check so I understand correctly. So you're saying that you think that investment into housing is not productive. Is that right?
I'm saying that it's that investment into business is more productive. Okay. But, I mean, I assume you're aware that we've got a housing supply crisis in Australia, so we need to get more like 280,000 dwellings built this year, but we're only going to get about 170,000 dwellings. So, I mean, isn't that also important to the Australian people that more houses are built? No, I agree with that. Yeah, in terms of the proposal was that that I put in that paper was that the 50%, the capital gains discount, which the current capital gains discount is maintained on new housing. To obviously to encourage that.
Right. Because I think there might be a danger in people classing investment in housing as unproductive. I mean, I think it might be a bit of a jarring message for people to hear, particularly for people who are under the age of 40, given the housing shortage, which is, I think, not going to be resolved unless there's more investment into housing.
And the proposal that I put in the paper was to maintain that one at 50% to obviously continue to encourage investment in new housing on the same level as investing in listed companies, shares, etc.
Right. And what do you, as an investor, what do you make about the investment scenario for people who are wanting to invest in housing? I mean, is it a low tax, medium tax, or sort of high tax scenario?
Sorry to Senator Bragg. What do you actually mean by that? Is
Well, I guess my question is, what do you make of the prospect of people investing into housing in Australia as an investor? Because there's different views. Some people say it's a high tax endeavour. Other people say it's moderate. Other people say it's a low tax scenario. So I'm just wondering how you see it as an investor, given the nation has a housing crisis and needs more investment into it. I mean, how do you see it from a tax point of view?
Well, I think broadly, if that like that Australians is sort of broadly, they see housing as an asset that they have confidence to invest in, and where they'll see equities as potentially higher risk. So I would say that that broadly that Australians are comfortable investing in housing.
So, what do you think would be the investor impact of your proposal to reduce the discount for existing properties? I mean, where do you think that investment would go otherwise?
Well, the thesis was where would the capital go, and it would go into Australian operating businesses that would be, that would help on the productivity side. That was the
right.
That was obviously, any new housing. Well, actually, it would probably go from old housing to new housing, or already built houses to new housing. That's probably the first step, which would, could possibly help the concern you were saying. And then, obviously, it's a significantly high risk profile of using capital to invest in a Australian operating business, and that was the logic of giving those people a encouragement, and that was increasing, the capital gains, to take that risk. That was the logic.
Okay, so they might invest more into shares or managed investments, or directly into companies.
And then directly into companies, yeah.
Yeah. Okay, that's good. Thank you. Thank you, Chair.
All right, thanks, Senator Bragg and Mr Wilson. Thank you very much for coming in and giving the committee the benefit of your evidence and your expertise. You have kindly undertaken to consider some matters on notice. If you do intend to provide any further information to the committee, we'd require it by Thursday the 5th of March in order for us to have time to include it into our report. But on behalf of the Senate and the committee, thanks again for your time today.
Thanks very much, guys.
Really appreciate that. The committee will suspend until 3 o'clock. From the University of New South Wales City Futures Research Centre. Thank you both very much for your attendance today. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you each please state your full names and the capacities in which you appear today?
Emeritus Professor Hal Pawson. I'm a former staff member of UNSW City Futures and still associated.
Thank you, Professor Pawson.
I'm Dr. Chris Martin. I'm an Associate Professor in the City Futures Research Centre at UNSW City.
Thanks very much, Dr. Martin. Does either of you have an opening statement that you wish to make to the committee?
Yeah, just very, pretty briefly, I'll try to reflect a bit of what we put in our submission. And really our submission and what we'll be speaking about today, I think, are very much coming at this topic from the housing dimension or the housing perspective, and what possible reform could be made to the CGT discount. For other assets, we're not really focusing on that. So we very much welcome the opportunity to participate in the inquiry, and thank you for that making that available. When we look at this from a housing perspective, our effort to make a sort of big picture view of this is that CGT discount is a very long overdue reform that we feel is urgent, and there seems to be some momentum behind that, but it's only one of a number of changes that we think really ought to be looked at in the round. Structural reforms that we would argue should be put through to rebalance our housing system. And that kind of holistic view is the kind of way that the Henry Tax Review approached the topic in 2010. And even better from our perspective would be a national housing strategy led by the federal government that was underpinned by a wide-ranging review of structural factors affecting housing affordability, including on the demand side of the market. So we certainly acknowledge that Australian governments, the federal government and most of the states and territories as well are very actively pursuing structural reforms on the supply side of the market, and that is all well and good, and we don't have any criticism of that. And that's evidently informed by a view that we need to try to calm the market or achieve a more balanced functioning, a market that's operating in a more balanced way. But we think it makes no sense to put so much effort into all of that and at the same time allow the continuation of a system where there's tens of billions of dollars per year effectively propping up the demand side of the market, which are making the achievement of those, basically undermining the achievement of the supply push objectives. So that's why we support significant reform to the CGT discount for rental housing and argue for complementary reform for other property taxes, and we think these kinds of changes are long overdue.
All right, thank you. Dr. Martin, did you wish to make any opening remarks?
It backs up Hal's opening remarks. I'd make the point that taxation is one of the crucial shaping factors for the Australian housing system. For decades, our tax settings have, or tax and other policy settings have ostensibly, at least, sought to promote home ownership through preferential treatment of owner-occupied housing as an asset. But over time, the various components of policy regime that ostensibly support home ownership have in fact come to support established homeowners, support them relative to would-be homeowners, and with the effect that this ostensible support for home ownership has in fact become support for existing homeowners leveraging their housing wealth into a bigger housing position as landlords, as rental investors. And that's been to the detriment of the opportunities for younger households accessing home ownership. We also, at least currently, this hasn't always been the case, even recently, but currently we've also got an ambition on the part of the national government and state and territory governments to increase the share of the housing system that is owned and managed by social housing landlords. Increasing the rate of home ownership and increasing the rate of social housing necessarily means decreasing the share of private rental. It necessarily, by identity, it means repressing landlords, to be frank. And I think that's something that it's true by identity, but isn't always faced up to. And I think we should be facing up to that amongst policymakers.
Thank you. Just to pick up on that last comment, what do you mean by repressing landlords?
What I mean is that over the long trend in Australian housing has been for the private rental sector to be growing, and in particular for ownership of housing by other households, not the people living in them, by other households as rental investments. And there's been, and that has had a number of negative consequences, both for the opportunities for home ownership, but also for how our rental housing system works as a place that people have been trying to make a home in for longer into their lives than in previous generations. So the structure of our private rental system, our private rental sector, it's dominated by small holding household sector landlords. They're high income, high wealth household sector landlords. We shouldn't lose sight of that. But it also means that this particular structure means that they very often trade in and out of the sector, and that is to say, properties trade in and out of rental. There's a churn of properties into and out of rental. That also means tenants get churned in and out of their homes when properties are transferred between the sectors. It also means that our affordable and social housing sectors face higher prices when they go to the market for land and housing. And they too get crowded out, just like would-be homeowners get crowded out. So we should be leaning into policy measures in tax and elsewhere that open up more opportunities for would-be homeowners and for our social and affordable sector at the expense of private landlords, because that's necessarily the case.
Yep. All right. Thank you. Understood. So you're from a City Futures research centre. Can I just ask you, what does our society look like into the future if we retain the current tax settings, as opposed to what our society, and in particular our cities, might look like in the future if we were to change some of the current tax settings that would deliver on, for example, an increase in home ownership in Australia and a corresponding decrease in properties owned by investors? I mean, what are the sort of high-level societal impacts or benefits of such a change?
Well, I think if you kind of just project the trajectories that we've been on for the last 20, 30 years especially, a continuation of the status quo would mean a more unequal distribution, particularly of wealth. Distribution of income isn't so unequal in Australia relative to the international comparators, but the distribution of wealth, that's where the real problem is. And there's a pretty wide consensus, I think, that has come about, and that is continuing to magnify mainly through the housing market. And therefore, the structure of the housing market, or the underlying architecture of tax and other settings, policy settings that influence that, are things which we need to look at and make some changes to if we don't want that long-term future that I've just suggested.
We've heard from unions who've told us that patterns of like where people live relative to where they work are changing, and that it's becoming harder and harder for more and more people to find accommodation close to where they work, so that they've got like convenient commutes to and from work. Would you accept that proposition, and what are some of the implications for our society and for our cities if you do accept that proposition?
Well, we certainly know that the way that the housing markets of our major cities function, the consequences of that functioning over the last 30, 40 years, we've seen a tendency for lower income populations to be increasingly excluded from inner and even middle suburbs. And those populations contain a lot of people with the necessary skills who are the essential workers, many of whom are needed to make the central city work well. But 30, 40 years ago, a substantial amount of relatively low-cost housing was available in inner cities, in Sydney, Melbourne, and other places. And that has, the way that the market has sifted properties and people over that time, since that time, has made that less and less feasible. So, yeah, therefore we need policy settings that try to keep that in check, or maybe even reverse it. And yeah, this isn't only about tax; it's also about land use planning as well, and reserving a proportion of affordable housing within market housing developments, especially in high-value areas where there's a lot of land value, some of which could be effectively captured for this purpose. Those are the kind of measures that we would advocate for trying to resist the sorts of pressures that you're talking about.
Yeah, thank you. From what you've said, I think you'll agree with this proposition, but I'll put it to you anyway. What I want to test is whether you'd agree that a reduction in the capital gains tax discount, or its removal, acknowledging that you're arguing for a phased reduction, would over time increase the proportion of our housing stock that is owned by people who live in those houses, as opposed to property investors who would face a reduction in the proportion of the housing stock that they own. Would you agree with that proposition?
Yeah, I'd agree with that. It tunes down one of the elements in an array of policy settings, particularly around tax. Connected policy settings, it tunes down one of them, and is would be a bit of a repression of the sort of demand that we see, that is, the degree of enthusiasm can wax and wane at different points in time, but our tax system provides a basic impulse for people, whether they're owner-occupiers, and also through different settings for would-be investors, to spend what spare money they have or what spare credit they can access on housing. And tuning down the investor one makes more space for owner-occupiers.
And does it flow then that the reason that effect would occur is because, in your view, that the capital gains tax discount acts as something that increases demand for investment properties?
Yeah, and in particular, it's part of the capital gains tax discount operating with negative gearing. The combination of them represents that gives the rental investor a tax flow advantage. The nature of their preferential treatment is a tax flow advantage relative to the would-be owner-occupier. The would-be owner-occupier has if you like, they're looking at the asset as having a capital advantage in that when they own it, capital gains aren't taxed at all. And it's the capitalisation of that advantage that investors can effectively ride on, because this is an asset, housing, that trades between these two different classes of purchaser.
Yeah, thank you.
And also, just if I could
yes,
just add to the answer to the beginning of the question, which just to say that we know from the modelling work that New South Wales government has done that the package of the reforming negative gearing and capital gains tax discount, basically on the model of the Shorten government or Shorten opposition manifesto, would over time restore home ownership to its peak level, which is 4 or 5% above where it is now.
Thank you. Your submission mentions self-managed super funds. These are currently skyrocketing in popularity, and I note that a self-managed super fund can actually borrow money to purchase property. Do you think that's a concern and something that's exacerbating some of the problems that you've outlined in your evidence?
That was yours.
Yeah, I mean, what the problem that we have here is I don't think the data on this part of the issue is as clear as it is on the bigger, more well-known part of the issue. So I don't think we have quite such a strong basis to make very precise claims, but certainly, and it is a smaller, in terms of the numbers of homes which are being purchased by SMSFs and rented out under that heading. It's a small part of the market, but I think because the tax advantage is so extremely generous to that form of investment, it definitely needs to be looked at, and it would be, if the ATO would surrender more data about the scale and the impacts of that would be useful.
Yeah, thank you. You talk about the significant tax advantages to that form, to that situation. I mean, are you referring there to the part of your submission that notes that if you're in your retirement phase and you sell an investment property from an SMSF, if that property's worth less than $2 million, it's basically a completely tax-free situation?
Exactly. So even the much better known generosity of the capital gains tax 50% discount for most investors is small beer compared with that.
Yeah. Thank you. Senator Dowling.
Thanks, Chair. Thanks for the submission. Is it your contention that issues that you've canvassed and concerns with the housing market are predominantly because of the tax system and the CGT discount, or do you acknowledge broader issues in the housing market?
I'd characterise our tax settings as a crucial shaper of housing system we have, including the balances between the different sectors, owner occupation and private rental and social housing.
The behaviour.
Yeah, and the behaviours of the institutions and the households that own it. There are other policy settings that bear on this as well, and that connect with tax settings, including, for example, the exemption of owner-occupied housing from the pension assets test. At a state level, the way land tax treats owner-occupied housing, but also the structure of it in relation to rental housing, and the fact that in most jurisdictions, most landlords don't pay land tax because they're beneath the thresholds that have been set way too high. Also, we could look to finance policy and macroprudential regulation in particular. And I said we should be looking to repress landlords. The last time there was a deliberate repression of landlords was just before in the late 2010s, when APRA and the RBA, APRA in particular, delivered some macroprudential rules that were mildly repressive of landlords, and we did actually see a slowing of the decline in the home ownership rate in the inter-census period after that. So it's been done recently by a policy that didn't go by the name of housing policy, but was in fact something that operated very specifically in terms of different housing classes and had an impact on those balances between the housing sectors. So we do have a range of different policy settings that operate in combination to shape our housing system and the way the sectors work and the way they offer opportunities to different actors.
And just to add to that, on the supply side of the market, which is where the current government's attention is much more focused, we completely acknowledge that side of the market has to be looked at as well. And it's just, we don't need to shout so much about that because there's not much resistance. That's the zeitgeist of the moment. And that's a lot more than just simplifying or doing what can be done to liberalise land use planning. Sure, that's an aspect of it. That's the one that's talked about the most. But there's actually a much wider range of ways that governments can and are attempting to ease restrictions on supply of housing as well. So those are we're completely cognizant of the fact that it's not just a story about tax is the only area that needs attention.
They do, sorry, they do join up though. Those we've currently got state governments reforming planning laws and to effectively give existing property owners additional property rights in developing at higher densities. Whether that will also mean that there are property owners who now have the ability or the right to develop say a 20-storey building where previously it might have been a 10-storey building. And they might be, that might mean that their calculation about when it is most profitable to develop changes, including to push a development further into the future, because that's when the 20-storey development will become the profitable option. So to change that calculation, our tax system has a role in changing that calculation, and in particular through land tax, making more costly the holding of land that can be a spur to bringing forward development and bringing forward housing to the market and making housing more affordable now. And that's an aspect of tax policy that has very direct application to the new supply agenda that states are pursuing, but it hasn't for too many jurisdictions. Victoria is a bit of an exception, but for too many jurisdictions, it hasn't been part of their housing supply ambition or their housing supply program. So that's something that the Commonwealth Government, in coordinating a working group on housing and tax and the various housing and tax arrangements that exist at the federal level and at state level to better coordinate the way these elements work in relation to other parts of the current housing agenda would be a really useful piece of work.
And that would naturally, we think, fall under the sort of aegis of KIFA, the Council of Federal Financial Relations. That's the established venue where the treasurers from the various parts of the jurisdictions talk about these kind of matters. We think a working party to discuss, to agree, or to review all of these kind of settings under that aegis would be the logical place for it to be.
Okay, thank you for that comprehensive answer. Your submission has there recommended specifically reducing the CGT discount for rental housing and leaving other asset classes aside. We've heard from a lot of witnesses an important tax design principle is neutrality, but you're obviously going a different direction and arguing for reform specifically targeting rental housing rather than capital gains more broadly. So what is the sort of tax principle that gets you to that position, sort of against what we've heard is good tax design from other witnesses?
I think we're more taking a position that we're more neutral about non-housing assets. Okay. I think we're maybe feel not as well qualified to venture an opinion about non-housing assets. Certainly, that's how I would portray the way I've come at this. But I do think it's important to recognise that housing is a very unusual asset in a lot of ways, and one way that it's unusual is that from an investment point of view, it's possible to obtain debt to invest in housing at far lower rates than it is to invest in productive businesses. And that's for the reason that it's a far less risky venture than many other forms of business investment. So from that perspective, I think there is a case for recognising that it doesn't deserve to have equal treatment with other forms of investment where the risk is really great, and for that reason you need to encourage it much more so than you do with housing.
On this productivity claim, because we've heard it's been a constant theme throughout that, and I think your submission argues that housing investment crowds out more productive investment and therefore could suppress national productivity. So, I mean, in some measures, housing itself is a component of national wealth and construction activity. So I'm just trying to understand the conceptual basis where you say that housing investment is less productive than other assets.
Housing is very basically productive in the sense that everyone needs it to get on with every other aspect of their lives, including going to work and going to school and staying healthy. So housing is essential to the productivity of everyone. But housing investment in the form of doing a new kitchen in a high-end property isn't productive in the same way as ensuring that a household that is otherwise homeless or a household that is in substandard housing that is insecure or makes them sick, is made more productive by having decent, affordable housing. So the capital gains tax discount doesn't do anything special for that household who really needs housing, decent, affordable housing, relative to the investor who is going to redo the kitchen because they think that that will put their property at a higher price point in the speculative market for rental housing that that the capital gains tax discount is a component, a facilitating component.
And another related to what Chris was saying there, one of the other possible ways that the capital gains tax discount could be reformed, which I think we may have mentioned, but in our submission, but only very briefly because it's not what we are recommending, but the idea of making the continuation of the current rules on capital gains tax, making the continuation of those rules conditional on making available your dwelling, your rental dwelling at a below market price targeted to people who need it, which is what Chris is saying, who otherwise wouldn't have adequate housing and therefore couldn't be productive in the economy. That is another possible way that you could justify making a change, a major reform to the capital gains tax discount in such a way that it is more contributing to the productive economy. Okay, thank you.
Thanks, Senator Dowling, and Professor Paulson and Dr. Martin, thank you very much for your engagement with this inquiry. And on behalf of the committee and the Senate, thanks for coming along this afternoon and giving your evidence.
Thank you. Thank you.
I now welcome representatives from the Centre for Independent Studies, the Real Estate Institute of Australia, the Urban Development Institute of Australia, and via teleconference, the Property Council of Australia. Thank you. And do we have the Property Council online?
Online, yeah.
Welcome, folks. Thanks for your attendance today. The committee really appreciates it. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. For the Hansard record, could you please each state your full names and the capacities in which you appear today? And we might run down the table this way and then we'll go online.
Andrew Mino, I'm the Head of Policy and Government Relations for the Urban Development Institute of Australia.
Thanks,
National
Mr.
Office.
Jacob Kane, President of the Real Estate Institute of Australia.
Thanks, Mr. Kane.
Robert Carling, a Senior Fellow at the Centre for Independent Studies.
Thanks, Mr. Carling.
I'm Peter Tulip. I'm Chief Economist at the Centre for Independent Studies.
Thank you, Dr. Tulip. And online from the Property Council of Australia.
Thanks, Chair. You've got Mike Zorbas. I'm the CEO.
Thanks very much, Mr. Zorbas. Would any or all of you like to make some opening remarks? I'll start with you, Mr. Mino.
Thank you, Senator. Just give me 1 second. So industry recommends, we actually work for all of the small, large and institutional developers as well as local government who are tasked with trying to ensure that there is enough rental and housing for homeowners in their electorates. And the industry recommends maintaining the existing CGT discount, including the current CGT incentive for affordable housing, and focusing on boosting housing supply to benefit all Australians. It's absolutely critical that we actually find ways to build housing that is in reach of Middle Australia's rental and home ownership ambitions, as well as providing affordable and social housing. We've heard several arguments to suggest CGT change, including discouraging rental investment in favour of home ownership, as well as simply taking the extra tax for other things. Neither are highly practical approaches which tend to distract us from the core problem, which is simply that we need to be taking more time to remove roadblocks for construction and building more housing supply. Around 3.28 million Australian families rent housing, and Australia relies almost exclusively on private investors to provide that. That's 83.1%. 9.7% is actually provided by government. There's no other source of rental supply that can deliver the housing needed in any reasonable time frame. Now, no one that we've come across is suggesting that we have an oversupply of rental housing. Neither is anyone suggesting we've got an oversupply of housing for home owners. In fact, current rental listings are 18% down on the decade annual average, and dwelling commencements for 2025 were 178,000 roughly, against the long-run average of 204,000. So we're not even building as much as we did historically. What we clearly see is the housing delivered for homeowners is the same housing delivered for renters. It's the same product in the same market with different people involved. From a 40,000-foot view, there's no point in discouraging investment in rental housing to boost home ownership, because all you end up doing is having the same supply problem shifted to a different part of the same market. You're not solving housing affordability by it, but you're simply shifting chairs on a struggling ship. Specifically in relation to the CGT discount, it makes no sense to deliberately discourage housing investment as you're cutting off your primary rental pipeline. So you would need to find another way to get that housing in place. Any CGT measures that were successful in discouraging rental supply over home ownership would end up eventually hurting them both, because rental supply is constrained while demand continues to grow, and as the gap widens, renters compete in a smaller market, putting upward pressure on rents. And quite feasibly, what happens at the end is the rents eventually hit a commercial rental rate that is significantly higher than current rates, and supply is provided at a much higher rental, creating exactly the same tensions we had before with homeowners and renters. The only way really to improve access to home ownership and rental affordability is to boost housing supply initiatives. We also note, obviously, that the CGT discount is tax foregone rather than government funds per se, and so it's hypothetical funding on what might be if no one changes behaviour. But obviously, and by definition, if you put something in that is going to discourage rental investment, you are going to change that behaviour. At best, it will extend hold periods for existing property and potentially undermine or stop some or all future rental housing. Some significant proportion of that 3.28 million rental properties will need to be replaced. And it's important to note that rental investors last year alone put 53,260 rental properties into the market that were built by those investors. So let's put that in perspective. That is almost exactly the same amount as the extended half over the 5-year period. And if we do decide for some reason that we want the government to do that, take over all housing for rental, the responsibility for providing that very optimistically means that you are going to be at least 18 months away from getting any expanded government rental property in the market as it currently stands. So our proposition is essentially it's absolutely critical that we are very, very clear on why we want to change the CGT discount. And if we want to change the CGT discount to encourage home ownership, then it's more likely that the only reasonable approach is to refocus effort and funds on more broader measures for housing supply. Having said all of that, as you'll know from our paper, we do recommend the time is absolutely necessary for us to do broad-based tax reform that encompasses all of the measures and all of the levers that are available, so that we get a systemic approach that actually reduces the price of housing by reducing the amount of tax on it, as well as helping with the fiscal imbalance in relation to income and capital investment. Thank you.
Thanks, Mr. Mino. Mr. Kane, yes.
Good afternoon, Chair and Committee. Thank you very much for the opportunity to be here representing the Real Estate Institute of Australia. The REIA is the peak body for the real estate profession here in this country. Our position on the matter before the committee is clear. We recommend the maintenance of the existing 50% capital gains discount for housing. Now, we take that position in the context of a housing system already under acute strain, arguably the most challenging housing environment that our country has had to navigate. Australia is operating in a structural housing deficit. The National Housing Supply and Affordability Council forecasts that only 938,000 dwellings will be completed during the Housing Accord period, which is a shortfall of 262,000 against that 1.2 million target. And that is a shortfall, we should note, that is increasing year on year. Alarmingly, net new supply is projected to fall short of new underlying demand. In 2024 alone, supply fell short of new household formation by approximately 68,000 dwellings. The NHSAC does not expect supply to exceed demand at any point over the next 5 years. The gap is not closing, it's embedded in the forward projections. In that context, any policy change that risks reducing investment in and delivery of housing is inherently problematic. Nearly 1/3 of Australians are renters, a cohort that is growing every single year. 6 in every 7 rental homes are provided by private property investors. Private investors, therefore, are not peripheral to the system, but they are the system. Throughout Australia, a balanced rental market requires a vacancy rate of 3%. In the simplest of terms, this means that in any given moment, there are enough rental homes available for the renters looking for them. Anything less than 3% means that there's a shortfall. The current vacancy rates across Australia are as follows. ACT, 1.1%. Queensland, 0.9%. Victoria, 2.4%. New South Wales, 1.8%. Western Australia, 2.6%. Tasmania, 0.4%. South Australia, 0.8%. Northern Territory, 1.2%. The reality is today that in every single state and territory, there are simply not enough rental homes for our rental population. The Henry Tax Review cautioned that in a constrained housing market, reducing tax benefits for property investors unavoidably reduces investment in property. Inevitably, the consequences are that rental home availability flatlines, rents skyrocket, and ultimately, the people in our community who shoulder the heaviest burden are those who often can least afford it, renters. We accept that there is absolutely an intellectual case for structural reform. Our position is certainly not that the tax system is perfect. It is that housing tax reform can occur only after, not before, structural supply barriers are addressed. We must first address planning constraints, infrastructure charges, construction productivity, workforce challenges and regulatory duplication. Tax policy should be neutral, efficient and predictable. Sudden shifts in long-standing settings risk reducing confidence at precisely the moment that we need high confidence to build more homes, not fewer. We urge the committee to prioritise supply reform first and to consider CGT changes only within a holistic, sequenced housing reform framework. Thank you very much.
Thanks, Mr. Kane. Would anyone from the CIS like to make a statement? Mr. Carling.
Yes, thank you for this opportunity. We are both researchers at the Centre for Independent Studies. Dr. Tulip has written and commented widely on housing issues, and I have done so on capital gains tax more generally, and we will follow that division of labour in answering any questions you might have. And I might add that as there is no clear proposal on the table from government, we don't know what we're reacting to, so our comments will be broad across not confined to housing. So, as well as the submission, there have been 3 relevant research publications on capital gains tax issued by the CIS in 2009, 15 and 19, and perusal of those publications would make it clear to anybody that we do not think much of proposals to reduce the 50% discount. Now, if 3 publications looks like an obsession on our part, we have had a lot to say on the issue because calls for the discount to be cut or eliminated have been a persistent theme of tax policy debate ever since the defeat of the Howard government, which of course put the 50% discount in place in 1999. Along with superannuation concessions and negative gearing, the discount has been a favourite whipping boy. Cutting the discount is variously seen as a key plank of tax reform, a revenue-raising measure, the key to lowering house prices, and a solution to intergenerational and vertical inequity. And our submission argues that it is none of those things, or at least not in significant measure, and that the 50% discount is justified. In brief, we make the following points. The principle of taxing nominal capital gains at lower rates than ordinary income is unexceptional and was recognised in Australia's first model of capital gains tax in 1985. The 50% discount in 1999 replaced what was essentially a different form of discount in the 1985 model based on indexing the cost base of assets to CPI inflation combined with an averaging scheme that limited the effect of lumpy capital gains pushing taxpayers into higher tax brackets. The pre-99 arrangements produced a variable discount, but for average rates of return on assets and inflation rates and various asset holding periods, it can be demonstrated that the effective discount often fell in the 30 to 45% range, and that is leaving aside the additional benefit of averaging that was available at that time. So the point is that the 50% discount, although it sounds enormous, is actually not much more generous than the average result of the policy it replaced. To those who say the 50% discount overcompensates for inflation, in some cases it does, and in some it doesn't, or it even undercompensates. But the key point is that it was never intended solely to compensate for inflation. It was meant to be a general incentive for saving and investment, which is needed now more than ever in light of stagnant productivity. On housing, several researchers have estimated the effect of cutting the discount would reduce house prices by a few percent while increasing rents in a similar amount. These effects are tiny relative to other influences on prices and rents. And CGT affects much more in the investment world than just housing. So housing considerations alone should not drive broad CGT policy. And carving out housing for a different treatment would be a step towards greater complexity. The claimed revenue costs of the discount, such as the $247 billion over 10 years that we've heard about, vastly overstate the revenue that could be gained from any reasonable or likely change. The claimed distribution of that revenue cost across income deciles is meaningless on close scrutiny, and cutting the discount would barely move the dial on income and wealth distribution. Changing the CGT discount on its own is not tax reform, but it could have a place in broad tax reform that substantially reduces marginal rates, and reforms the taxation of income from saving across the board. However, we don't hear anybody in government talking about those kinds of options. So we can expand on these points in response to your questions, but the key conclusion is that there is a very strong case for some form of tax concession for capital gains relative to full marginal rates. This concession should go beyond simply allowing for inflation. While various structures are possible to satisfy that condition, the current 50% discount, and don't forget the 1/3 discount for superannuation funds, has the advantage of being simple, has been the basis for investment decisions over the past 26 years, so it's entrenched, and it is well understood, and there is no strong case for changing it. Thank you.
Thanks, Mr. Carling. Mr. Zorbas, did you have an opening statement?
Yes, thank you, Chair. I'll belt through this in part because being online, I have that liberty. And of course, in speaking, I pay my respects to the Wurundjeri people of the Kulin Nation from whose land I'm joining you. I want to make 5 points and find myself largely in agreement with our previous speaker. But firstly, from the Property Council's point of view, representing all the leading owners and investors in property of all types around the country, there are really 3 key questions for proponents of a CGT change, especially as appears it's going to target only housing, and I think I'm safe in making that assumption based on public comments from people who would know. Firstly, how do you not shrink the supply of new rental homes, including for first home buyers whose median age is now heading towards 40 in Sydney and Melbourne, noting the price trajectory of new homes, as has been alluded to, is barely touched by any housing CGT changes proposed to date, and all of those models show some degree of supply shrinkage. And noting too that you would need to factor in the secondary effect that when a purchaser of a new apartment looks forward to selling to an investor on a lesser proposed CGT discount, as well as the fact that the second Longview PEXA research white paper a couple of years ago by Dr. Jane Frances Kelly shows that even under the current settings, were you to assume they were generous, 60% of rental landlords would be better off putting their money directly into their own existing super fund. So that's the first test. The second limb of the test is how do you avoid the obvious distortions caused by a pile-on into the share market relative to new homes, and what does that represent in terms of equity? And thirdly, how do you avoid wrapping up any of the changes in the administrative barbed wire we occasionally see around housing legislation from the federal sphere, like the long-delayed federal build-to-rent changes that occurred a couple of years ago? My second broad point is supply of more housing to own and to rent is the best solution for housing affordability and intergenerational equity over the decades to 2050. We are in part having this conversation because of decades of collective ignorance and neglect on zoning, assessment and tax settings at 3 levels of government. No one in this committee, of course, but that has shrunk housing supply by 1.3 million homes relative to the 20 years of housing production prior to 2001. Not to say there hasn't been national reform progress under this federal government's welcome housing targets, have tipped federal cabinet and state premiers and ministers, but much more to be done. Third, many of the 7 factors that we think matter most to availability and affordability of Australian homes are still headed in the wrong direction for all home buyers right now. Population is growing, people per household is shrinking, personal cost of credit is rising, taxes on new homes by federal, state and local levels of government are rising too. Construction costs, including the rampant criminality driven by the CFMEU, which adds to all building form project costs, are not coming down. And the biggest, supply, accounting for the last 2 affordability factors, is mostly made up of state and local politician-controlled land use limitations and project assessment handbrakes across what is otherwise a land-rich, low-population country. So from an economic point of view, nothing else even comes close to improving supply settings for fixing that intergenerational fairness equation that I think we're all interested in. Fourthly, tax in perspective. Trailing along behind supply, if you really care about fairly taxing all buyers, an astonishing 1 in every 3 gold coins that you hand over for your new house adds to the fatberg of combined government taxes on a new home. In some cases, it's 40%, Greenfields Victoria being a good example. Many state governments' budgets are effectively built on hideously efficient stamp duties. This is vastly more material to the housing affordability solution than the one-off 1 or 2% reduction in house prices assumed by hiking the CGT on rental landlords, which also, as we've heard from this panel and from Grattan on Monday, hurts housing supply. Fifth, with particular regard to the raw ability and high likelihood of the government getting change through the Senate in the next few months with Green support, I'm forecasting the future here, let's see if I'm right, of the least bad options which have been aired through this process to date, and keeping in mind they all harm the supply of new homes according to the modelling that we have seen over the last 6 or 7 years, even with the essential grandfathering factored in and leaving aside the blind optimism of the modelling itself, and I say this with some affection about McKell's modelling, 70% they are proposing on new apartments an actual increase in the CGT discount and retaining 50% on new detached housing model seems to be the least bad of the disruptive changes proposed if indeed change was to go ahead regardless of some of the problems that have been raised. So in conclusion, post-approval permitting and utility connection in particular needs to be fixed as a national priority, very much a part of that supply equation across every state and territory. Good progress has been made in zoning and assessment and more needs to be done, of course. But this is where any money that would arise from that disruptive change, which we are not in favour of, must be pointed to, because at the end of the day, state and local housing supply and the performance of that supply eats federal tax hikes for breakfast. Thank you, Chair.
Thanks very much, Mr. Zorbas, and thank you all for, excuse me, for your opening remarks. Fair to say there was a lot of discussion about housing supply there, and you're obviously well entitled to bring that perspective to the committee. I can certainly tell you there's been a preponderance of support through the evidence we've received for increasing housing supply in Australia, and I'm very confident to say, I mean, Senator Dowling will correct me if he thinks I'm wrong, but I'm very confident to say no one on this committee is arguing that an increase in housing supply would be a bad thing for the country. Very happy to place that on the record, and certainly that's my view and the view of my party that we certainly need an increase in supply. But fair to say, is it not that the key driver of prices is the interaction between supply and demand, and this committee is also looking at the demand side of the equation. So I wanted to start by asking, I'm very happy for each of you to respond to this. Would you agree with the proposition that high house prices are a part of the housing challenge facing Australia? And if you do, or even if you don't, would you accept that the capital gains tax discount has played a role in increasing demand and therefore increasing house prices in Australia? I don't mind who goes first.
I'm happy to go first.
Dr. Tulip, thank you.
Yes, house prices are one of the worst social problems Australia is facing. Affordability typically rates the very top of opinion polls and voters' concerns for, I think, very sensible, understandable reasons. No one's going to disagree with that. Removal of the CGT discount would reduce prices. There have been a number of research studies of the size of that effect. They all conclude that the effect is tiny, if not trivial. I think the best single study was by some Melbourne University researchers, Cho, Lee and Yuren. They estimated that removal of the CGT discount would reduce house prices by just a trivial amount, less than 1%, while increasing rents by 1.3%. So while affordability is a problem and lower prices are good, rents are a similarly important part of the overall affordability problem. And if you remove the capital gains discount, you increase rents. So overall, the effect on affordability, it depends on how you weight prices and rents, but many, many people, including me, would think that overall you make affordability worse because you're increasing rents with a really tiny effect. And I should say, That's the estimate by the Melbourne University researchers. Several other researchers have also looked at this, and they all conclude that the effect on prices is tiny.
All right, thank you. Mr. Kane?
Look, I'd echo Peter's comments there. The modelling, I think, uniformly shows a very marginal impact on prices. And yes, to your first question, we have at the moment 4 cities of our capital cities sitting in the least affordable housing markets in the world. It is the greatest challenge facing our country right now, and absolutely we need to do more.
Thank you. Mr. Mino?
Yes, thank you, Chair. In relation to this, as we pointed out earlier, yes, high prices is a massive challenge, and it is the major challenge. And I have a sympathy for the comments you've made previously in relation to home ownership versus rental. The interesting point about this, and this kind of gets to the heart of the matter, if you take a look at the fact that rental investors are the only one, really, 83.1%, providing rental into the market. So it is the supply of rental. So if you remove that rental supply, unless every single one of those renters is going to buy one of those properties, you're still going to have renters. And the problem that you're going to have is you will have renters, but then you will have no platform and no pipeline for being able to get more rental properties. And so over time, what you will see is a cascading effect. Now, as we pointed out, last year, about 53,260 new rental apartments or houses were created by investors. So that is actual supply. That is actually going into relieving the housing affordability issue. So overall, what we see, one, there is a mediating factor by rental investors that is actually helping with reducing supply and taking pressure off prices. And the second thing is completely understand the concept that you have a level of supply, and leaving aside the investment that's gone into the market from the investors unilaterally, that 53,000, there is also a number which are competing directly with homeowners. The only way that you actually change that equation is by literally building more houses, as you already know. And anything else is really just shifting the problem on one side or the other. And if you shift it one side or the other, you end up having that same problem come back to you, because you will end up in a situation where you've reduced to zero, essentially, all of the rental supply being put into the market because the rental investors are no longer putting anything in, and yet you're going to have increasing renters moving forward, as is always the case. So it's going to put pressure on prices, and that's going to be a circular effect that bites back onto homeowners. So having said all of that, the reality is where the beginning and end of this discussion happens is what do you do about providing rental supply into the market if you are going to take the rental supply away from investors by getting rid of the CGT discount.
Mr. Zorbas, do you have a response to my proposition that house prices are too high in Australia and that the capital gains tax discount has played a role in that?
Look, they certainly are too high, Chair. I would put, as most economists do, the fault at the 1.3 million missing homes that we lost out on between 2000 and 2020, as has been modelled by former RBA guru not so long ago. The fact is, that is the vast bulk of the price problem in this country. Hugely delayed supply. We're actually a population light, land-rich nation. We should be able to build plenty of houses very, very easily, and we've basically done everything we can to tax the hell out of them and make it incredibly difficult to do, much like we do with tobacco, for example. The only other thing I would say is I find Mr. Tulip's logic compelling, and again, that 0 to 4% one-off price shrinkage, no matter which end of that range you decide to choose as your preferred model is tiny next to the 30+% total tax take on a new home from all levels of government. And of course, if it is in fact closer to that 0 to 1% discount, that effect on house prices in an environment of increasing interest rates is almost washed away within a year. So again, this is not the big contributor.
I mean, Dr. Chulip, you've spoken about your view that winding back or abolishing the CGT discount would have a, I can't remember the words you used, but I think it's fair to say, trivial. But look, 1 to 4%. I mean, on an average house price, that could be tens of thousands of dollars, could it not? Are you seriously going to look a working Australian who's on $120,000 in the eye and tell them that a $40,000 saving on their home is trivial? Because it's not, is it? That's a significant saving, is it not?
That would take average house prices back to the level they were at, what, in October?
The 1 to 4%.
September?
Well, that's the 1 to 4. Well, that's right. That's the scale of the problem we're facing here, Dr.
When we were having exactly the same discussion about housing affordability. So it's, it would help, sure, but you've also got offsetting effects on rents. That while you're making prices more affordable, you're making rents less affordable. So the overall effect on affordability is ambiguous.
Well, I'll come to rents in a minute, but the New South Wales Treasury submission describes 1 to 4% as, quote, a material injection of demand. So, I mean, you might call it trivial. The New South Wales Treasury calls it material. I'm suggesting to you that a reduction in house prices of tens of thousands of dollars would not be trivial to someone who goes to work 5 days out of 7 and is pulling home an average wage in Australia. That would be a significant reduction in the size of their mortgage, would it not?
And I do not disagree with what you've just said there, but all of these things are relative. So in terms of other government policies that are driving house prices, the effect of zoning regulations is adding 50, 60, 70% to the cost of houses. If you want to have a discussion about how government policy can improve housing affordability, let's talk about planning. This CGT, I think there are equity issues and efficiency issues to do with it. It does not belong in a discussion of housing affordability.
Okay. Although you do accept that it would assist with housing affordability if it were wound back.
No, I don't accept that. It will reduce prices, but it'll make rents worse. All right. It'll increase rents.
All right, so it'll reduce prices. Come to rents now.
Yeah.
We've heard from Saul Eslake this morning, very, might I say, extremely well-regarded independent economist in Australia. He says this, contrary to oft-made assertions, purchases of established housing by investors do nothing to increase the net supply of rental housing because by outbidding prospective owner-occupier purchases, investors who purchase established dwellings are effectively increasing the demand for rental housing by the same amount as they are increasing the gross supply of it. Hence, any reduction in the CGT discount, and this goes to your point, Dr. Chulip, would not have any material impact on the supply of rental housing or on rents. Dr. Eslake wrong about that, is he?
I would like to see Dr. Eslake's comments on the research results, where several papers have directly examined this question, trying to estimate it, and they find that a reduction in the CGT discount would increase rents. And, okay, the effect is tiny. I think the best estimate out there is by the Melbourne University researchers I mentioned before, which was just 1.3%. And I can completely understand how some people would say that's not material, because relative to the other government policies we talked about, it really is swamped. If Dr. Eslake has critiques of the published estimates, we'd all be very interested to see them. I haven't seen them. I haven't seen Dr. Eslake's estimates, so I can't really criticise them.
All right, no problems. I guess I'll ask the question. Would you accept that if the CGT discount were reduced or removed, or made less generous or removed, would that change the percentage of our housing stock that was owned by owner-occupiers as opposed to property investors? I'll start with
yes.
you,
Yes, there would be. We would have fewer renters and more owner-occupiers. I've not seen good, credible estimates of the size of that effect. In contrast to estimates of prices and rents that we've seen, I think we can estimate those reliably. Changes in tenure are much harder to estimate, and I've not seen good estimates of the size of that.
All right, thank you. Mr. Kane?
Yeah, absolutely concur. You hope that that's the outcome, that renters are having that opportunity to purchase their first home. The challenge is, of course, that I think one of your witnesses over the course of the past couple of days, Cathal, apologies for the pronunciation, Leslie, cited a study which showed that it might be 1 in 8 based on changes to the CGT. And that, again, it presents a problem, and there's almost a perceived assumption that it can be a 1-for-1, that one investor out, one renter in. And the brutal reality of the price point at which we're at right now, the cost of servicing a loan to get into a property, is that the overwhelming majority of renters are not in a position to either pay the deposit or meet the serviceability requirements. So again, how we get from where we are right now with the levels of home ownership to where aspirationally we want to be, that's a very complex set of interconnected policy settings that need to move all at once with support mechanisms in order to prevent that undue and disproportionate level of pressure falling on the shoulders of the rental cohort.
Mr. Minor.
Thank you. I agree with everything that's been said, especially noting when I heard it with quite surprise that people were suggesting that it would be great if we got rid of CGT completely because 1 out of every 8 renters would be able to get a home. Aside from the fact that you then have 7 renters that are still in the market and you have no way to provide them with that rental, I do have a grave concern that unless we're saying we don't care what happens to renters who are left in a market which is now shrinking, that is a equally inequitable situation to be in. And the only other comment I would make, in addition to everything that's been said there are better ways to bring housing prices down. Up to, depending on which research you look at, up to 50% of the price of a house can be taxes and charges. There are numerous ways that we can be able to do that, which will more directly reduce it than with CGT, which has the added complication of throwing a number of renters to the wolves when their market shrinks and they have to go and find a new place.
Thank you. Mr. Zorbas?
Nothing additional from me, Chair. Thank you.
All right. Senator, yes, Dr. Chilton.
The idea that 1 in 7 or 1 in 8 renters might become an owner-occupier strikes me as just quite implausibly high. To buy a house in Australia at the moment, you need a deposit of $100,000 or $200,000. The renters I know do not have that much cash in their bank accounts.
Yeah, well, times are tough for many, many, many millions of Australians, including overwhelmingly young Australians. And we have heard, I might just go to the intergenerational elements now. We heard from Bill Kelty yesterday. I'm not sure if you saw his comments, but he described Australia's current tax system as obscene and cruel because of its impacts and its unfairness towards young people. And he lumped the capital gains tax discount in as one of those unfair measures. So I just want to put to you all, and I'm going to declare myself as not a young person anymore, and I suspect I can speak on behalf of potentially most or all of the current witness panel that wouldn't identify as a young person. 4% of the benefit of the capital gains tax discount goes to people under 35. Now, that wouldn't surprise anyone. As you move through life, you, as a general comment, you're more able to, or more likely to be able to afford to buy things that would appreciate in value, and when you sell them, of course, whether they be shares or real property, you can avail yourself of the capital gains tax discount. But it is it not? It's an intergenerationally inequitable tax discount, given the almost non-existent proportion of the benefit that goes to young people. Would anyone take issue with that? Dr. Tulip.
The big intergenerational distribution has gone to existing homeowners, and they have received enormous capital gains. So it's a question of whether, if you remove the discount, whether you make it retrospective. In the past, established taxation policy is to grandfather these changes. And if you do that, which in fact was Labor Party policy in the 2016 and 2019 elections, then you're doing nothing to recoup those capital gains that the existing generation of old homeowners have made. So you either grandfather this policy or you do something for intergenerational equity. You can't do both. And existing policy has always been to grandfather these changes, so it doesn't do anything for intergenerational redistribution. The premise of Mr. Kelty's question is exactly right. We have a terrible intergenerational problem because of the zoning restrictions, which are locking young people out of the housing market. Fix that. The tax system won't change it.
Anyone else? Mr. Carley?
Just a general comment on these distributional issues. Look, the tax system takes into account, or should take into account, issues of incentive or economic efficiency, simplicity and equity, okay, broadly speaking. And it makes, but that's for the system as a whole, and it makes no sense to dismiss any one tax or tax measure on the grounds that it doesn't satisfy, it does not balance all of those criteria appropriately. You need to look at the tax system as a whole. So if you were concerned about equity alone, you wouldn't have the GST or excise duties because they're regressive, but they have a place in the whole tax system. And the whole tax system has been very well demonstrated to be progressive. And the focus is always on how much capital gains tax is not paid because of the discount. So how about looking at the capital gains tax that actually is paid? And there is $31 billion of it this year. And if you did the same graph of the distribution of that across income deciles or age groups, you would find the same distribution as you do for the supposed revenue foregone as a result of the discount. So the reality is that the capital gains tax, as it is applied, is highly progressive.
Progressive?
It is highly progressive because the tax actually paid is heavily skewed towards higher income earners.
Mr. Kane?
Look, accepting the expertise of my colleagues on the panel here, my view is, inescapably, it is a contributing factor to intergenerational inequity, and in due course, in a better context, we need to look at all of these instruments and how we make it a more equitable landscape for all Australians.
Thanks. Mr. Mino, do you have any thoughts you'd like to share on that?
I think Mr. Robert Carling really covered it off very nicely, and it was a very good point. I don't think I can really add anything more to that would help you.
Thanks, Mr. Zorbas.
Thanks, Chair. Nothing to add.
All right, thank you. Mr. Carling, just a final one to you from me, and then one to Dr. Tulip, and then I'll offer the call to Senator Dowling. You've argued that the capital gains tax paid is progressive, but would you accept that the capital gains tax discount is regressive?
I think that, well, obviously it is, because with all the qualifications that attach to those estimates, I mean, I've seen figures going out 10 years. It's hard enough to estimate what capital gains tax is going to be next year, let alone in 10 years' time. But they also take no account of the fact that a lot of those people counted in the top income decile are there temporarily because of these big lumpy capital gains. So the whole thing is circular. Also, those estimates don't mean that the government would gain that revenue from making a change, because they don't make any allowance for the behavioural adjustment of the taxpayers. So the revenue actually gained by making a change would be much less than those estimates of revenue foregone.
Is that because you think there'd be a locking in phenomenon where people might delay realising capital gains until potentially their retirement when they're in a lower tax bracket?
Yes, it's partly that. Look, they would invest in different things. They would invest in, shares with fully franked dividends and so on, especially if the CGT arrangements remain unchanged for shares and they change for housing. But also the point that you just mentioned, that there is a powerful lock-in effect. The capital gains tax is essentially a turnover tax. And if you tax it more heavily, you'll get less turnover. People will hold on to what they've got for longer.
That lumpiness that you mentioned, sorry, I will come to you in a sec, Dr. Tulip, but that lumpiness that you mentioned, which is effectively that, as I understand it, and we've had evidence about this, that when people realise a capital gain, that's obviously treated as income, which bumps them up into a higher decile on the measurement scale. That's what you're referring to, is it, Mr. Carling?
Sorry?
Lumpiness. That's what you're referring to, the lumpiness?
Yes, that's what I'm referring to, exactly, yes.
Accepting that, because obviously that is logical, but it's not your contention, is it, that the capital gains tax discount doesn't significantly bias towards wealthier or high-income people? That's not your contention, is it?
Well, no. I'm just saying that graph that is displayed so often exaggerates the reality.
Thanks. And Dr. Tulip, last question for me. You mentioned that the current 50% concession is not much more generous than what it replaced, which is indexation. But some would argue, would they not, that indexation of the treatment of capital gains is in fact itself quite a generous approach, because we don't index, for example, income tax. How would you respond to that?
Robert, do you want to? That's more a tax policy question.
Yeah.
Sure.
Well, it certainly, when it was put in place in 1985, they took all those considerations into account and provided indexation anyway. Yeah, of course, the tax system is uneven in its treatment of inflation, but I think there's a very powerful case for doing it in the return on assets, because that is the income from those assets. The capital appreciation part of it, at least, there might be a recurrent income component also, such as rent or dividends and so on in the case of shares. But the capital return is the whole appreciation. That's a major part of the total income from that asset, is the capital appreciation. So if you don't allow for inflation in that, in many cases, you would be taxing the gains in such a way that the real value of the asset would be shrinking. Put it that way. It would be doing that, having that effect.
Mr. Mino. Yep.
Thank you. Just in relation to your previous question, where you were talking about high income earners, I think something that may actually help you with that is something we put in our submission, which is essentially the majority of rental. This is based on ATO key statistics from 2022-23, which is the latest amount that are there. But the majority of rental properties, which is about 61%, are owned by people who earn less than $100,000 a year. And if you look at the breakdown, it's about circa 657,437 by people who earn between $50,000 and $100,000 a year, and 437,096 rental properties actually relate to people between up to $50,000. So it kind of gets a little bit of a better picture on exactly what the distribution is and gives you a much better understanding of what the lumpiness is actually doing to distort the feeling of who's getting this. Could I also make one other point? In the current system, Australia has relied, and the government has relied on private investors to create the rental that goes into the market that helps people. So they have relied on people going out and buying these properties because it's impossible to rent out a property unless somebody owns it. So if it's not the government, it's got to be a private individual. At the end of the day, it is axiomatically going to be the case that if you are relying on the private enterprise or private individuals, and which a lot of them are, people who might own a small business and simply are using it to safeguard their future for superannuation, in those circumstances, it's a little bit of a disconnect, I suppose is the best way to put it, to say we don't like you being rich or we don't like you being able to afford to buy this property, yet we want you to provide rental. So that disconnect really has to be worked through to work out whether or not we actually want private investors to provide us with that rental property so that we do have renters that are looked after, or whether or not you want to shift it to somewhere else. But somebody has to do it. Out of those 8 people, 7 of them are still going to need a rental property. And they're not going to thank anyone if they're having to search through a market that's half the size or a market that is somehow much more pricey.
Thanks, Mr.
Thank you.
Senator.
Excuse me, Mr. Chairman, could I just add very briefly to my answer on
Yes,
inflation
yes, you
in the
may.
tax system?
Yes, you may, Mr. Carter.
That no organisation has been stronger in its advocacy of indexation of income tax brackets than the CIS.
Thanks, Mr. Carling. Senator Dowling.
Thank you, Chair. I think this is all being looked at through the prism of housing, and obviously the CGT is much broader than that. But just a couple of points to clarify on the housing. Some of you have argued that house prices are primarily, I think all of us, structural supply constraints, and that the CGT discount plays a very minor role in price formation. But then we've also argued that reducing the discount could significantly reduce rental supply and push up rents. So I'm just trying to understand that tension, that if the concession's too minor to materially affect purchase prices, but what is the mechanism by which it can materially affect rental supply and rents? Because it can't be small on one side and huge on the other. And also, if you could just explain to me how the rental market works, that landlords are able to just pass through any costs that they bear, because to me I would have thought it's a function of supply and demand, and if landlords are able to just pass through any additional cost, why wouldn't they be doing that already? Okay, we can...
I would argue that the effect on both prices and rents is tiny.
Trivial both ways. Okay.
Trivial both ways. The reason it increases rents, it's not a pass-through of costs, it's because it discourages investment. So you get less supply, and whenever you get less supply, prices go up. And so you get an overall reduction in the supply of housing, but in particular, you get a reduction in the supply of rental housing, partially offset by an increase in supply of owner-occupied housing.
Okay.
So that's why prices fall and rents rise.
So it's not, in summary, it's not a big deal either on either side of the...
Correct.
Okay, thank you.
You go.
Yeah, sorry. The point I was making, and I didn't speak to the quantum in terms of the impact on rents going up, but to Dr. Tulip's point there, any reduction in supply automatically translates into an increase in rent. And I read through those vacancy rates right now, which again are evidence of the absolute, I don't like to be overly dramatic, but catastrophic state of play in the rental market right now. So the impacts of anything minor is compounding. It's amplified because of the context that they find themselves in right now, that we find ourselves in a country. So that's the concern there. With regard to the passing on of costs, now there's an interesting makeup in investors. We heard from Andrew around the average earnings there. We've also heard across I think the past few days, a lot of people who've made sweeping statements or generalisations around the sophistication of the investors, the number of investors or the proportion of investors that are using instruments like negative gearing. To clarify, less than 50% of all investment property owners utilise negative gearing. You combine that with the income there, and what you actually have is probably a class of Australians that aren't sophisticated investors, that aren't utilising all of the instruments and machinations of tax law to their advantage, right? They're just, we use this expression ad nauseum, but the mum and dad investors who've effectively been told that this is a means by which, but that securing an investment property is a means by which they can safeguard their future. They can safeguard theirs and their family's future, and they've slogged their guts out and put aside some cash and taken an opportunity to take an additional step in the property market. Now, what is the actual reality for them from a financial perspective is that they're very sensitive as investment property owners to fluctuations in the market, interest rate rises, to maintenance requests from their renters, to things that would impact their cash flow on a day-to-day basis. Now, those types of investment property owners are the type disproportionately that will seek to pass on those costs, right? And you layer that on the current constrained rental context that we find ourselves in, where demand is far outstripping supply, and that gives landlords, rental providers as they're called in Victoria, the opportunity to sort of pass on those costs when they arise relatively easily, because the market dynamics are such that prices are increasing at such a rapid rate. And we can see that across the country, that median rental prices have increased by 45% in three years.
Okay.
Does that answer?
No, it does, and we're both from Tasmania, and I think that had the lowest rental.
0.4%, right, which is... I spoke with the president of the Real Estate Institute of Tasmania just last week, who's been in the game for a long time, and he said it used to be 10%. It used to be really comfortable for renters, and we're at 0.4%, which if you call 3% balance, we're talking like we've got 15% of the available properties that you need in Tasmania to actually house the people that are looking for them. A little side note, just this is relevant and important. I don't have enough empirical data to bring right now, but we are seeing the lead indicators in Victoria, which has gone through an enormous amount of regulatory and taxation change in the rental market. We're starting to see household sizes increase, right, which is the opposite trend of everywhere else in the country. Now, how we're tracking that is applications and leases. We're seeing 4 people on 2-bedroom apartments where we used to see 2 people. We're seeing 6 people on houses where we used to see 3 people. Now, that is a direct product of the absence of supply, not enough homes in the marketplace, and the price point at which it takes to get into those houses. If those houses are $1,200, that's $400 per 3 people historically. They can't afford it. They can't afford it. So what are they doing? They're going, let's move in with partners, or let's bunk. They're making these kind of lifestyle sacrifices in order to get in. So we've got a massive issue.
Okay. Just a couple more. Maybe one for Dr. Tulip, but feel free, anyone else. That we have heard that around the introduction of the 50% discount in 1999, we saw an acceleration in house prices, and so there's obviously a correlation-causation discussion there. But as I've asked others, we saw that similar trend in other jurisdictions around the world as well, US, UK, New Zealand. So to what extent was there global factors going on versus CGT? And obviously, Dr. Tulip, you've talked mainly about zoning being the primary driver, but was that also something was just relevant to the Australian market, or that also drove those international price rises?
The big thing that happened in that period was that world interest rates fell. And we know from very strong, robust research in lots of different countries that interest rates have huge effects on house prices. So while you've got a reduction in mortgage rates, partly because real long-term interest rates fell, but also there was, financial liberalisation, so that, anyway, for various reasons, mortgage rates fell all around the world for the same reason, and it had the same effect, pushing up prices. There's no puzzle to be explained as to the increase in prices. The fall in interest rates explains it. And as you point out, the change in taxation arrangements was unique to Australia. So the timing is clearly a coincidence.
Yeah. Okay. Mr. Carling, in principle, do you have any issue with the way the discount system operated pre-1999, the 85 model that was just operated on indexation?
Do I have any?
What was wrong with that? Did it need to be changed?
Oh well, it was, first of all, it was more complicated, and especially for people who have share investments and participate in dividend reinvestment plans, they end up with a long stream of small holdings. You have to do the calculations for each one based on quarterly CPIs. So it was that. But secondly, I don't think that, that system was designed to tax 100% of real gains at people's marginal rates. And I think that capital gains taxation should be more concessional than that.
So there's a case for a concession beyond inflation, in your view?
There should be a concession going beyond just inflation adjustment. But what I think the best thing about the pre-99 arrangements was the averaging provision, which everyone now seems to forget about. But it was a great feature of those arrangements.
So do you think it's an incorrect way to look at it, where people make this comparison of what people pay for their labour income and that they pay less on their capital gains, and that's not a neutral way, and we're taxing labour higher than we're taxing capital gains? You don't think that's the right way?
Completely apples and oranges to say, well, if you have 50% discount on capital gains, you should have 50% discount on wages. The capital gains are part of the return on capital, and wages are the total return on labour. And if you want to draw an analogy, then the appropriate thing to do to make an inflation adjustment for wages would be to automatically index the income tax bracket thresholds every year, which, as I said, we have strongly advocated. But otherwise, there's no comparison between capital return and wage income.
Okay, thank you.
Thanks, Senator Dowling. I believe we have Senator Bragg remotely, so if you hear a disembodied voice, that will be Senator Bragg. Over to you, Senator Bragg.
Thanks very much, Chair. Look, I do have a few questions. It's a bit hard not being in the room, so I'll ask them and then you can allocate them, or witnesses can feel free to respond. So I guess if there was a reduction in the concession, what do you think would be the impact on rents?
Well, I'm just going to repeat my previous answer before you joined Senator Bragg. I think the best available estimate is by several Melbourne University researchers who estimated that removal of the capital gains discount would increase rents by 1.3%. There have been several other studies all coming up with fairly similar estimates. Everyone that has done the numbers on this agrees that the effect is a small positive increase to rents.
Senator Bragg, I'll just assist you by trying to choreograph the choir here. I think Mr Mino has a contribution.
Thank you, Senator. In relation to that, I don't disagree with anything that's been said there. And as was said previously, the difference between the price that we're talking about and the later effects of reductions in supply is because of the discouragement of investment, and that depends entirely upon what the concession is. So totally agree with what's been said. However, the other point is, depending on what you do in terms of that concession and how big that change is, if you are reducing it by an amount that is going to discourage more rental investment, then over time what you will see is future pipeline declining. And as the gap widens between demand and supply, you will automatically see an increase in rents as a result. And I suppose that probably goes to your answer, Deputy Chair, as to why there's that difference between the two approaches.
All right, thanks. Senator Bragg, I think next question.
Okay. So, thank you. So, it sounds like the view is that there would be slightly higher rents if the concession was to be reduced. I mean, it also sounds to me that no one is saying this is the way to solve the housing crisis. So, I mean, in politics, people want to apportion blame, or they like to link things, or they like to say that, if I do this, then I'll get a particular result. But, I mean, it doesn't sound to me that anyone thinks that this would solve the housing crisis.
I agree with you. This is not a way to solve the housing crisis. There are better ways to do that, as we've pointed out, and I think the added complication of what you do with a market that you're discouraging that is wholly there to provide rental supply has a very distortionary effect on what happens for renters in Australia.
I think it makes the rental crisis a bit better for owner-occupiers, and it makes it worse for renters. So overall, I think many people would argue that this would make the overall housing crisis worse.
Now, one of the other issues that might emerge if the government decides to progress this in some form will be, I imagine, that they would want to say that they're going to use some of the revenue, the revenue which is currently foregone, for other purposes. But, I mean, it would be good just to hear from you whether you think that revenue might be illusory. My sense is that just because it appears in the tax expenditure statement, it doesn't mean that it's money that can be spent on other things, because it's a tax expenditure. It's not like a tax collection that you receive from an individual or a company, so to speak.
Yeah. To this end already, I think Dr. Tulip.
You can only use that revenue, get substantial revenue to use for other purposes in the next few years if you're retrospectively taxing capital gains that have already occurred. If, in contrast, you grandfather those tax increases the way most people have done and the way the Labor Party proposed in the 2016 and 2019 elections, the revenue from this is tiny, and it doesn't allow you to give much spending for anything.
Totally agree. Do you have any sense of what the revenue would look like?
Yeah, no, I don't have those numbers.
Senator, in answer to your first query, I agree with what's been said. At the end of the day, you will end up with a situation that you see revenues. It relates to tax foregone. It's not actually government funds, so nothing's been given out to anyone. It's just simply tax not collected. And that tax not collected is in basic form a what would be if behaviour does not change. However, we can tie ourselves up in knots as to what the actual changes are going to be, but if we are looking to put in changes that are there to specifically discourage rental investment, you can expect that there will be a change in behaviour. So you are not going to see those revenues come through. In addition, depending on what you do to it, if the CGT will be delayed over a longer period of time, if it eventually does come through in any form whatsoever, and it goes to homeowners, then you will basically see those tax revenues decline. So you're not going to get year-on-year revenue changes anywhere near the quantum that are suggested as the tax revenues foregone.
Okay. Now, what about the capital gains tax in relation to social and affordable housing? I think there's an extra 10% that ATO says that you can apply if you use properties for affordable housing. Is that something that would be affected by these changes if they were adopted in some form?
Yes, Senator, I think they would be affected. I mean, if you are going to do a wholesale change, especially if you're going to remove it completely, it has to affect it. So, it is it's a very interesting point that the government is already using CGT discounts as a way of encouraging affordable and social housing in a positive way. And so we have this mix and confluence of conflicting ideologies on what CGT discount is doing. Is CGT discount there to help us through affordable social housing and providing rental? Or, is it something that needs to be removed because you want homeowners? At the end of the day, the reality is, unless you have both, it's like a seesaw, right? You need to balance rental supply with housing supply. If one of them or other is out of balance, it will impact the rest of that market. So,
it seems to me that there's like a lot of arbitrage here. I mean, at the moment, sure, mum and dad investors are incentivised to provide rental supply to other Australians. Some people think that's good, other people think it's bad. But the government, nonetheless, have a whole agenda to support the idea of institutions engaging in providing properties for others to rent, whether that be through the build-to-rent tax arrangements, whether that be through the changes that the Treasurer is asking ASIC to look at through the disclosure arrangements through RG97, which I know that the Property Council and others have pushed. So there appears to be, the Housing Australia Future Fund, there appears to be a big push here to replace mums and dads with institutions. I mean, is there any evidence that mums and dads are bad landlords?
There's a lot. Australia has some of the worst rental insecurity in the OECD. We have more turnover of tenants, and that turnover is disproportionately driven by landlords, and that reflects the fact that we have the wrong landlords, that most of our rental stock is owned by mum and dad investors, as you mentioned, who only offer very short leases and they churn. I think the median rental property in Australia only lasts as a rental for 5 years. It's more than double that in many European countries because their rental stock is owned by large landlords who offer long-term leases and want the tenants to stay as long as they can. So yes, I think there is strong arguments for preferring institutional landlords over mum and dad landlords.
Well, I just have one more.
Can I make one quick comment on that, Senator?
Yes, so Senator Mr. Mino's just going to make a quick comment and then you've got one more question.
It's absolutely undoubted that build to rent is an important and integral part of the market to provide diverse rental housing. It is, no doubt. It largely deals with premium into the market, and largely that's because it's going for commercial rents. Currently, mum and dad investors, because of the history of what's been happening with the concessions, etc., have been providing rentals at uncommercial rents. So they are much lower rents. So at the end of the day, if you remove them from the system and you say, we're now going to require you to make it an income investment, that means that you're going to require people to actually have properties wash their face, which means rents go up. So irrespective of whether you're doing BTR or something else, the net change is going to be ultimately that if anybody's providing anything to the rental market for rental supply and there is a change to discourage any of the existing concessions, you will end up with over time, an increase in rent and a pressure on rent. So it is a very important thing to have BTR for particular cohorts, but it doesn't necessarily answer the problem for every single renter who's out there. And they would clearly admit that that is not their intention in any event. They do not intend to be everything to everyone.
Okay. I know I've got to wind up, so I think I've only got time for one more. Look, I just wanted to ask the Property Council, just because I was just a little bit unclear on your opening statement. So does the Property Council support a reduction or removal in the TGT discount?
No, there was nothing unclear about what I was saying, Senator. It's simply a matter of observable fact that the numbers in the Parliament would suggest that if the government wishes to do something here, they only require the support of the Greens. And in the event that you go through all the different things that have been mentioned over the last couple of days, you look at the least bad option, something that, increases the emphasis on new supply is obviously the least bad option, but it still has all of the downsides that I went through in my opening statement, which include, reducing supply. And ultimately, that is the only game if we want equity in this country in housing over the next 20 years is to radically increase the amount of supply. And that is using patient institutional capital, that is using mum and dad investors. There are, questions, of course, to be debated around broader tax reform in terms of equity, but there is no question that the only game in town is radically boosting supply, and that's the Property Council's long-held position.
Thank you.
All right, thanks, Senator Bragg, and thanks to everyone who's in the room and Mr. Zorbas remotely on behalf of the committee and the Senate. We thank you for your engagement with this inquiry. I now welcome Professor Alex Robson from the Productivity Commission. Professor Robson, welcome, and apologies on behalf of the committee for the fact that we're running a little bit late, and we appreciate your indulgence there. I understand that information on parliamentary privilege and the protection of witnesses giving evidence to Senate committees has been provided to you. Remind you that the Senate has resolved that an officer of a Department of the Commonwealth or of a state shall not be asked to give opinions on matters of policy and shall be given reasonable opportunity to refer questions asked of the officer to superior officers or to a minister. This resolution does not, however, preclude questions asking for explanations of policies or factual questions about when and how policies were adopted. Commonwealth officers are also reminded of the Senate order specifying the process by which a claim of public interest immunity should be raised. A copy of the order is available from the Secretariat. For the Hansard record, could you please state your full name and the capacity in which you appear today?
Alex Robson, Deputy Chair of the Productivity Commission.
Thank you, Professor. Would you like to make an opening statement?
No.
No? All right. I'm going to suggest, Senator Dowling, if you're good to go, that you might lead us off. So you have the call. Thank you.
Thanks, Professor Robson. I think you're well placed to take this question straight up, which we've heard a lot of over the 80+ submissions of witnesses about capital allocation and that the capital gains tax distorts investment into what some have claimed is lower productivity housing, where it could be going to more productive parts of the economy. How do you view the operation of the capital gains tax discount on the issue of productivity?
Senator, I might start just by putting it in context. So our labour productivity in Australia has basically remained stagnant for the last decade. So that's the broader context, and we worry about it at the Productivity Commission, obviously because it's in our name, but also because it's a key driver of long-run living standards and real wages and amongst other things. We have not done any work, recent work, on looking at the influence of capital gains tax discount on the productivity question you're asking about. We have the last report we looked at, and this was in 2004. We have said things about housing construction productivity, and I'm happy to talk about that, but we didn't look at tax arrangements as part of that.
No, well, maybe I can just keep it more in a simple conceptual sense. Yep. Is housing a productive asset? And I know it contributes to GDP, but is it a productive asset?
Well, anything
and relative to other assets.
Look, I'm not going to opine on relative to other assets. In principle, housing provides services to people; they value it. Puts a roof over people's heads, provides sources of income to landlords, and a source of capital gains to people who are saving. So in that sense, to the extent that it's valued, it's productive. Now, the question of whether tax arrangements push, create a distortion among different asset classes, we have not looked at that. But to the extent that that was the case or not, you would worry about it from an aggregate productivity performance standpoint. But we just haven't looked at that question. But what you'd want generally from a tax system would be something that didn't distort too much between different asset classes or savings vehicles, or indeed different ways of working, or different investments in different areas of the economy across different industries, because one benefit you provide in one area tends to come at a cost to another area and prevents the value of resources flowing to their highest value, and that drags down overall productivity. But that's a general comment.
Yeah, no, and I'm only asking in a very general sense, because I've heard other members of the Productivity Commission sort of reflect that we have this issue that a lot of capital in Australia is not potentially going to areas like entrepreneurialism, risk-taking, areas that could that are sort of restricting business dynamism, these sort of things. What's your view that is there a capital misallocation, and is that affecting productivity?
We've done work on the amount of investment as share of GDP in Australia. It's declined by around 3 percentage points since the global financial crisis, and capital deepening is a key driver of productivity growth. And so it's really the level that we were looking at rather than the distribution among the things that you're talking about. And so that's where we focused in our most recent reports on dynamism, around that level of investment as a driver of innovation and productivity across all industries and all areas, rather than focusing on, well, why aren't we getting investment in certain sectors and not in others?
Okay. Although I thought the Commission may have reflected on the entrepreneurialism and risk-taking, and obviously to accelerate that you would need more capital going to that part.
Yeah, we didn't look at that in our most recent work. We haven't looked at that specifically. Not saying it's not an important issue, but we looked much broadly at the corporate tax system as a driver of investment across all of the things you're talking about, as well as more established industries, not just startups.
Okay. And do you think that the structure of the housing market has an impact on labour mobility? Because I know that labour mobility is also a challenge for productivity because labour's not getting to where it can add the most productive value, potentially because of the way the housing market is structured.
Yes, absolutely. So, any cost the person moving to a more productive job or a higher-paying job is, that would create an economic distortion, and something we should be worried about.
And what would be driving that?
Well, look, again, people have pointed to things like stamp duty as a tax on, moving properties. These things, anything that drives a wedge between, what you expect to get out of the move versus the cost of it, then that would, that creates a distortion in the moving sense. And it's not just, moving between cities. It might be moving within a city to a different job, those sorts of things, or upgrading to a larger house because you want to start a family. Those sort of things. Tax arrangements definitely affect that.
Has the Commission done much work on intergenerational equity?
Yeah, so we put out some work a couple of years ago on sort of mobility, intergenerational mobility in Australia. And so what that work broadly found was that it's quite high in Australia relative to other countries. And there's a various number of ways you can measure that. We did find, though, that there's stickiness at the bottom and the top. But in general, if you look at sort of correlation between, say, parents' incomes and children's incomes, if that correlation is high, that tends to tell you that, well, there's not much mobility. In Australia, it's fairly low. And so relative to other countries, economic mobility, and if you take that as a measure of intergenerational sort of equity, it's reasonably good in Australia.
So even though we've heard a lot about wealth inequality, but you're suggesting there's a relative degree of mobility within that. So it's not deterministic. The circumstances you're born into are not necessarily deterministic of where you'll end up.
Yeah, I mean, that's a generalisation.
Yeah,
but for certain groups, there's differences. So for women, it's different. Aboriginal and Torres Strait Islander people, there's differences there. Regional areas, there's differences. So on average, it's not to say that mobility intergenerationally couldn't be improved by policy. It's just saying, relative to many other countries, Australia is in a pretty good position.
And just in terms of tax policy design, do you think it's appropriate to discount gains in capital, one, for the effect of inflation, but two, beyond the effect of inflation?
We haven't done any work on that question, but I'll give you a summary of the view of a couple of views, and I think that's the best way of doing it. So there is a view out there going back decades that income is income, and so you don't want to create a situation where people could characterise labour income as capital income to get a lower tax rate. And so there are reasons why you might want to make those two rates similar. More recently, though, there's a view put forward that, taxation of savings should be taxed concessionally for a number of reasons. One is, it's really a tax on future consumption. And so why do we have, we're taxing consumption today less heavily than tomorrow if we want to have the same, so you're sort of double taxing future consumption. So in that sense, savings should be taxed concessionally. In addition to that, there's a view that, part of the sort of return to saving is actually return to labour. So I go out, work hard. Part of that working hard is I know I'm going to be able to save for a house or some other savings vehicle and use that savings in retirement. And so what I'm really thinking about when I'm making my choice of how much to work and so on is part of it is thinking about those returns. And, so to that extent then, part of the return to saving is a kind of a return to labour income. And so you might want to, you don't want to avoid double taxation, and so you want to have a lower tax on savings as a result of that, because it's already been taxed once when you work.
Yes.
And so you'd be taxing it again. On the other hand, again, there's equity considerations. So these are all the things you've got to think about and take into account when you're forming a view. So I'm not going to give a view one way or the other, but there are good economic reasons why people say that taxes on savings vehicles, not just capital gains, but other savings vehicles should be taxed. It should be done concessionally. For example, the Henry Review in 2010 went through all of these arguments quite carefully, so I recommend you read that.
Yes, thank you. Thanks, Chair.
Thanks very much, Senator Dowlings. We have Senator Bragg remotely, and I believe he has some questions for you, Professor Robson. So, Senator Bragg.
Well, thanks very much. I just wanted to ask you, the national government is spending tens of billions of dollars on housing, but the supply figures are going in the wrong direction. So the average in the last decade was we'd get about 200,000 dwellings a year. Now we're down to an average of 170,000 over the last 4 years. What's going on? How can it be that the Commonwealth is spending so much money on housing, but we're getting fewer houses?
I'll answer it this way. So we did some work recently on productivity in the housing construction sector, and it was the first time, to my knowledge, that we've actually come up with some numbers on, specific to housing construction and what's been happening on productivity. So if you look at, say, measures like time taken to build a house without adjusting for quality or size, productivity's basically declined by 50% over the last couple of decades. If you take something like a detached house, 10 years ago it took around 6 months to build. Today it takes around 10 months. So across the board, productivity in that these new houses and housing construction has declined, and it's not just something that's happened over the last few years. Something has been going on over the last decade and before that. So we looked at possible reasons for this. One is relative to other industries, a lack of innovation in housing construction. One is a problem of scale of businesses that are in that industry. Another is around workforce issues, in particular around occupational licensing and mobility of workers between states. And the final one is around speed of approvals and those sorts of regulatory constraints. So we didn't make any recommendations to government in that report, but it's part of the answer to your question is probably going to relate to productivity growth in the housing construction sector, which, according to our measures, has been going backwards.
Well, that's thanks to the CFMEU and associated bad guys. But finally, then, can I ask you? There's been a bit of debate about whether or not investable housing in Australia is heavily taxed or lightly taxed. I think the IMF and others have said that it's heavily taxed. Does the Productivity Commission have a view on the level of tax and general regulatory burden on housing in Australia?
I won't comment on the tax aspect of it, just because we haven't done any recent work looking at that. I mean, on the one hand, owner-occupied housing is capital gains tax free. On the other hand, you don't get taxed on imputed rent. On the other side, you've got investor who do pay capital gains, but then they can take advantage of negative gearing arrangements. So, those two things, you'd need a pretty careful assessment to say whether investor housing was more heavily taxed than owner-occupied housing and other asset classes, and I'm not going to do that here. On the regulatory burden, we put out a report on dynamism and resilience in the Australian economy, and part of that looked at the regulatory burden in Australia, and one of the examples that we pointed to was in housing. So we think there's opportunities there to improve regulation right across the board in terms of faster approvals and lowering those costs without sacrificing obviously safety and other things that people care about.
Okay, thank you very much.
Thanks, Senator Bragg. Professor Robson, has the capital gains tax discount played a role in taking capital out of more productive parts of the economy and shifting it into less productive parts?
I think, as I said before, it's not something that we've devoted reports or analysis to. I'm going to point you to our 2004 report, which is the most recent, even though it's not recent, work in which we looked in some detail at this. But that was it's more than 2 decades ago. So
yeah, I mean, going back to 2004, we know from released cabinet papers that in that year, 2004, the Productivity Commission did advise the government that the capital gains tax discount was turbocharging house prices, not shares, as was the policy intent. Do you feel a bit vindicated?
Well, I wasn't there at the time.
Well, on behalf of your organisation.
I mean, it is. So, I mean, I'll just read you the points from that report. And I don't want to sort of quote it out of context and I'll tell you about the recommendation in there as well. So we said that other aspects of the personal taxation regime, including negative gearing rules, capital works deductions, the 1999 change to capital gains tax and high marginal income tax rates, have combined to magnify the attractiveness of investing in residential property during the recent upswing in house prices, thereby adding to price pressures. So it's more of this magnification story rather than a direct, and it's in combination with certain other features.
Sure.
And so the main recommendation out of that report was, because there's many other things going on in the housing market you want to be careful about, and all the other things you've heard about today regarding retrospectivity and impacts on rents and equity concerns and progressivity, and all of these things are very important. So our main recommendation, although we don't like making recommendations like this, was to do a review of the capital gains tax discount at that time.
I mean, not even Treasury agreed with you at that time. I mean, what you found in that report has at least to some degree played out in reality since 2004, hasn't it?
Look, I couldn't give an opinion on that. We haven't done the work to isolate what aspects of price increases can be attributable to various features. Obviously we said that in the 2004 report, but over the subsequent 20 years, I wouldn't want to hazard a guess as to what's been driving prices across the country.
So you wouldn't be prepared to suggest that the capital gains tax discount has played a role in driving house price increases?
I think it's a question.
It stimulates demand, does it not?
Look, I don't know what the counterfactual is, so it's hard to say, to give an answer to that, Senator.
All right, no worries. Just a couple of further quick ones from me. That advice that I referred to, the intended cabinet advice, which that I referred to in my previous question, also raised concerns that the capital gains tax discount was going to amplify upswings and downswings in economic activity. Is that anything that you've looked at since 2004?
No, Senator, no.
Okay, so you don't know whether that part of that advice sort of played out or not?
Yeah, it's impossible. So, I mean, we're an organisation, we're evidence-based organisation. We look at data carefully. Yeah. We're independent, but with that independence comes a fair bit of responsibility. And so, I'd like to be able to opine on all sorts of things, but part of my job and the job of the Commission is to, and in our, under our legislation, is to gather the evidence, talk to people, and do all of that carefully, and come to a pretty careful judgment. If we were asked to do an inquiry on this, that's what we would do, and we'd look at all of these things. or if we were to, to devote resources to self-initiated research in this area, we could do that. But there's, that's a question of what we devote resources to and other work that we're doing.
Yeah, all right, fair enough. The RBA has monitored over the last decade a sharp increase in both dividend payments and share buybacks. That corresponds with a sustained slump in productivity for this country. I'm certainly not suggesting it's the only cause, but is it possible, and again, I guess I'm asking if you've done any work on this, whether dividend imputation and share buybacks, which by definition cause less reinvestment of capital back into productive parts of the economy, is that playing a role in the productivity slump?
We have not done any work on that. I mean, we are very concerned about, as I said before, the drop in investment in Australia. We think the biggest lever was around the corporate tax system, and then secondary to that, the broader regulatory environment. So yeah, we haven't looked at those kinds of issues that you.
All right, and last question from me, and I suspect for you today, is I understand that you're doing some work on business investment at the moment. Is that right?
That was work that we put out in December.
Work that you put out in December. Yeah. Are you looking at doing any work, or are you doing any work on personal investment rather than business investment?
No. So that has not been on our agenda. I mean, we have in the past looked at Australia's superannuation system. We've looked at access to finance by small business. But personal investing, yeah, we haven't done any recent work on that to my knowledge, and don't plan to at this stage.
All right. Well, thanks, Professor Robson, for your attendance today. The committee and the Senate really appreciates your engagement with the inquiry, and you go with our thanks.
Thank you.
That concludes today's hearing. Thank you to all witnesses who appeared, and to Hansard and Broadcasting and the Secretariat for their assistance. I advise witnesses that responses to any questions taken on notice should be provided to the Secretariat by Thursday, the 5th of March 2026, and the committee now stands adjourned.